Okay, can we get started with this topic now? Yeah, one of the big ticket topics, which is amalgamation. They're saying work from home, sir. Yeah. Some students wanted to come, so that's the reason no work from home for me. Work from academy only. Yeah. See, a final I did from work from home. Yeah. This one I can't do it. Yeah. All right. We'll see. So amalgamation of companies. Sir, amalgamation is backed by accounting standard 14. AS 14 talks about amalgamation of companies. Sir, amalgamation means one company absorbing other company. Suppose if A Limited acquired B Limited, that is also amalgamation. Sir, A Limited, B Limited came together. A Limited, B Limited came together. They merged and formed a new company called C Limited. This merger also is accounted as amalgamation. It could be one company purchasing other company or two other companies merging and forming a new company altogether. Both are treated as amalgamation and both are accounted as per AS 14 itself. That is one meaning. Okay. Next, so for accounting purpose, sir, there are two types of amalgamations for accounting purpose. One we call it as purchase method. Another one is merger method. Purchase method or merger method. For merger method, they have specified 5 conditions. For merger, they've given 5 conditions. If all the 5 are satisfied, it becomes merger method. Even if one among 5 fails, it automatically becomes purchase method, like that. So if the questions call out the method, if question only says it is purchase method or merger method, don't bother testing the 5 conditions. Okay, directly start with the problems. If at all they don't give which method, then you test and accordingly find out whether it is purchase or merger and do your further accounting treatment. So what are the 5 conditions of merger method? 1. All assets and liabilities of the selling company have to be taken over by the purchasing company or new company. And all these assets and liabilities have to be taken over at book value only. No adjustments to be done. Okay, second one is this. Third one, the shareholders who are holding minimum 90% equity shares in selling company. That shareholders who are holding minimum 90% shares in selling company should also become equity shareholders of the purchasing company. That is one. Whoever is holding 90% selling company should also become shareholders in new company. It's not necessary they have to own 90% in new company. It is just that they have to become shareholders. They could own 5%, 20%, 90%, 100%, whatever. But they should become shareholders also in the new company. Fourth one is the PC payable to above shareholders. The purchase consideration payable to above shareholders has to be in equity shares only. There's one exception called fractional shares, where which you can pay cash. That we have discussed in class. Now I'll not go too much in details there. The last one is the business of the selling company should be intended to be carried on by the purchasing company. Meaning after takeover, the business of selling company should not be shut down. It should be carried on. If all of this are satisfied, then merger method. If one of them also fails, then automatically it becomes purchase method. Merger method ka another name is pooling of interest method. Okay, that is one. Now, if you remember in our regular class, I've given you some notes also or steps to solve purchase method and merger method. So the way we'll do it here is we will run through the concepts of all of this and then apply it in few questions. Okay. All right. The first is let's run through the purchase method. Purchase method. What is the first method of first step of purchase method? Anybody remembers? First is to calculate net assets. First to calculate something called net assets. So name itself is saying net assets. It's not assets, it is net assets. How do you calculate net assets? Assets minus liability. Not as simple as that. Net asset is asset taken over at agreed value minus outside liabilities taken over at agreed value. Because when one company is purchasing another company means selling company ka all assets and liabilities. Selling company ka assets and liabilities will be taken over by purchasing company. Suppose somebody purchased ArivuPro, our business somebody purchased. Okay. Yeah, hopefully it doesn't happen. Yeah. If it happens, means probably when some student only will purchase the thing. These guys have bugged us too much. Yeah, we'll take care of them. Yeah. So if somebody purchases our company, is it necessary every assets of ArivuPro company they should take it over? May not be. They feel this laptop is old as you. We don't want it. Possible. So some assets they may not take over. They may not take over. So here net assets means what, sir? All the assets taken over by which company? New company or purchasing company. At what value? Not book value, at agreed value. So just now you said book value. That is for merger method. I'll tell you the logic of all that also in a bit. Here we're talking merger method or purchase method. purchase method. So first calculate assets taken over at agreed value and minus what, sir? Outside liabilities taken over at agreed value. That you find out. That is your net assets. Sir, when you buy someone's business, can you buy it at free of cost or you have to pay some money? Money you usually pay to outsiders or owners? Owners. Which company is shutting down over here? Selling company. Who are the owners of selling company? Shareholders. Who are, or what are the types of shareholders we could have? Equity shareholders and preference shareholders. So if purchasing company is giving anything, to the owners, that we call it as purchase consideration. Purchase consideration is simply amount paid or payable by the purchasing company to the owners of the selling company. And who are the owners of selling company? Equity shareholders and preference shareholders. Okay, you can give anything to these owners. You can give them cash, you can give them debentures, equity shares, preference shares, some assets, doesn't matter. Everything will come under the ambit of or everything will constitute purchase consideration. If you're giving it to owners, it becomes PC. What you give is irrelevant. Done, sir? And compare net asset with the PC. Compare net assets with the PC. So suppose I have a cash of 1 lakh. I have to pay 20,000 to, let's say, Kumarana. I have cash of 1 lakh. I have to pay 20,000 to our Kumarana. That means what is my net worth, sir? How much is my worth of me now? I have cash means this is my asset, correct? And I have to pay him how much? 20,000. That means this is my liability. How much am I worth now? I don't have any other asset or any other liability. How much am I worth? 80,000. So my net worth is 80,000, correct? So hence, sir, asset minus liability gives you what? From assets, if you deduct liability, what are you going to get? Net assets. Hence, net worth we call it as, or net asset we call it as net worth of the company. Net asset is nothing but net worth of the company. Thank you. Valuable class. Awesome. This is over. All right. So first you have calculated net assets, then you have calculated PC. For what drama? For comparison purpose. So, but before that, if PC is not given in the problem, if PC is missing in the problem, some problems they don't tell how much is purchase consideration. So if PC is missing in the problem, what do? Calculate net assets, and net asset itself becomes a PC, because net asset means worth of the business. No? Sir, if the worth of the business is 80,000 means, and if they don't tell how much purchasing company paid, if the worth of selling company is 80,000 and if purchasing company does not tell how much I have paid, how much you have to pay logically? Whatever is the worth, that much you need to pay and acquire. Worth is how much? 80,000. That worth only we call it as net assets. So if PC is missing, net asset itself becomes your PC. You adopt this methodology only if PC is missing. If PC is given in the problem, don't say, sorry, I will do this. No, because PC is a negotiation. Sometimes you could pay more than the worth. Sometimes you could pay less than the worth. Or sometimes you could pay exactly the worth amount, because all these are negotiated numbers. Okay. So if they give the PC, calculate it the way they have told. If PC is missing, then calculate net asset, and that itself becomes your PC. This is important in question. Always watch out for this. That is one. And then you compare. So what do you compare? Worth with PC. Basically net assets with the PC you compare. Net asset means net worth. Here let's say this is your net assets. This is your PC. In the first case, sir, net asset is 5 lakh rupees. I think this, net asset is how much? 5 lakh, I assume. PC you paid 8 lakh. Net asset means net worth, no sir? So how much is the worth of the business in first case? 5 lakh. But how much did the purchasing company pay? 8 lakh. For 5 lakh worth of business, purchasing company paid 8 lakh. So purchasing company paid less or they paid more? More. How much per more they paid? 3 lakh. So purchasing company made profit or they made loss? Purchasing company made a loss because they paid. I'm not talking from selling company perspective. I'm talking from purchasing company perspective. 5 lakh worth of business, they paid 8 lakh. So purchasing company made a loss. This loss only in AS14 terminology, we call it as goodwill. Okay. We don't know why we paid this extra for. That AS14 is asking us to treat it as goodwill. That's all right. Sir, it has to be this scenario or it could be opposite scenario also. Opposite scenario also. Sir, net worth is, or net asset or net worth is 10 lakh. But PC paid was only 9 lakh. What is the worth of the business? 10. But PC paid is only 9. That means think from purchasing company perspective. So purchasing company made a profit, loss what? They made a profit. These are recurring or non-recurring profits. Every day do you do amalgamation or once in a blue moon activity? Once in a blue moon activity. So it's a revenue profit or a capital profit. capital profit. All capital profit you will transfer it to capital reserve. So this 1 lakh you will transfer it off to capital reserve like this. So compare PC with net assets. Either you may get some goodwill or you may get some capital reserve. If PC is equal to net assets, then neither you will get goodwill nor you will get capital reserve. That was a scenario. Done, Asaru? Usually we didn't do this in bigger problem because in bigger problem they used to ask journal entry. Okay, and normally journal entry number 2 used to get goodwill or capital reserve as a balancing figure. So if you're doing journal entry, I'll also tell you that in the problem, then this particular working note may not be necessary. But sometimes they tell in the problem, directly do balance sheet. No journal entry, directly balance sheet. Will this goodwill or capital reserve come in balance sheet? Yeah. If you're doing journal entry, goodwill or capital reserve value, anyway you will get it as balancing figure. But if you're not even doing journal entry means, how do you know the value? Then you'll have to put up a working note. Okay, so take a call. If there was journal entry in the books of purchasing company, this steps need not be followed. Otherwise, you need to follow the steps like that. We'll solve 1 or 2 questions like that also. Fine, sir. All right. So why can't we compare this profit or loss from selling company perspective, sir? Because you're saying profit or loss is made by purchasing company. But if purchasing company makes loss means selling company made profit, no, sir. Why can't we take it from their perspective, sir? Sir, selling company there are Goindana. That is shutting down, right? So all this accounting is done by whom? Purchasing company. Hence, profit or loss is always accounted from the purchaser. Who purchased your business? Seller or purchaser? Purchaser. So profit or loss, no, you'll ascertain from the purchasing company perspective or new company perspective and not selling company ka perspective. That is the logic. Okay, move on to the next. All right, sir. They will ask you to also prepare balance sheet. Now you think, sir, selling company will have some assets, it will have some liabilities, it will also have share capital and reserves in surplus. In purchase method, what and all of selling company, purchasing company will take over. In purchase method, what and all of selling company, purchasing company will take over. Will they take over assets? Yeah, they may be interested. Will they take over outside liability? Yes. But what about shareholders funds like share capital and reserves in surplus? Like ArivuPro, we have a reserve. Will anybody interested to take over our reserves? No. Sir, they are only interested in our assets. They are only interested in our liabilities. What will they do with our share capital? Can we give our share capital to them? My company only is shutting down. So what will be the value of my shares? 0. What will be the value of my reserves and all? Goinda. So in purchase method, what will the buying company take over? They'll only take over assets and outside liabilities of selling company. Basically, reserves and surplus, share capital and all will not be taken over. Under which method? Purchase method. Move on to the next. Next, we have another method called merger method. Okay. Now this merger method, stupid method. What, sir? Yeah, stupid method. Why, sir? Check this, sir. Let's take a small example. Sir, there was one Mr. X. He was controlling A Limited also. He was controlling B Limited also because he was a majority shareholder in both. 100% of share, let's say 100% of shares was held by A Limited or Mr. X. 100% shares in B Limited was also held by Mr. X. So he was controlling two companies. A is a separate legal entity. B Limited is a separate legal entity, separate company. One day he got bugged. He's like, two companies, I'm bored of controlling you both. You become one. Marry and become one. I don't want to control you two individually. I want to control only one company. So you two ka marriage happen. Meaning let you A Limited and B Limited get merged. So these two companies got merged and they formed a new company called A B Limited. Okay, now A Limited and B Limited got merged and a new company called AB Limited was formed. Now, sir, AB Limited as a new company means they have to give purchasing company has to pay PC. Here, new company is AB Limited or purchasing company is AB Limited. They have to give PC. PC is given to any Tom, Dick and Harry or owners. Owners of which company? Selling company. So, PC will be given to owners of selling company. Who's the owner of A Limited? Mr. X. So who will get PC? AB Limited will give shares to whom? Mr. X. So now B Limited also got sold. So B Limited ka PC again will be paid to whom? Mr. X. So PC will be given to whom now? Mr. X. That means now Mr. X will control which company? AB Limited. Because AB Limited is a new company. Mr. X got majority shares in the new company. Now X is still controlling which company now? AB Limited. Okay, now you tell me, is this really a business purchase or reorganization? This is merger method is not really a sale of business. It is just a reorganization or reshuffling of a business. Okay, this is your merger method. Understood, everybody? This in Ind AS 103 CA final, we call it as common control transaction. Meaning before business purchase, who was controlling? X. After this amalgamation also, who's controlling? Mr. X. Like that. Understood? Same thing, you learn it there also. Now you think logically. Previous method we already studied. What is the name of previous method? Purchase method. Under purchase method, assets and liabilities of selling company, you took over at book value or agreed value? Agreed value. Yes, no? Because maybe this mic ka book value may be 10,000. But its market value may be only 7,000. Because we have used it left, right, center. Okay, sometimes we have thrown not at students, yeah. Just saying it has fallen and maybe its value has broken. Yes, no, sir. Now book value of this asset is 10,000, but market value is only 7,000. Now if somebody acquires our business, he will value this mic at book value of 10 or its correct value. Its correct value, which is how much? 7,000. Correct, no? Because he will only pay what is its correct worth. Yes, sir. That is in the case of actual business purchase. This scenario is an actual business purchase or it is just a reshuffling? It's a reshuffling. Now you logically understand selling company ka all assets and liabilities will be taken over at revalued amount, agreed amount or book value only? Book value only. Because this is really a purchase just or reshuffling. Reshuffling. Instead of A Limited and B Limited, now it has become AB Limited. All the data of A Limited, you transfer it to AB Limited. All the data of B Limited, you transfer it to AB Limited at same value. Hence, for merger method, since it's a reshuffling, now you think logically, will any assets be left out by the purchasing company or everything will be taken over? Every assets and outside liabilities will be taken over at revalued amount or at book value. At book value, that's the merger condition. Is that okay, people? That's it. Okay. Now, once again, assets and liabilities taken over. Only assets and outside liabilities or also reserves and surplus. Even the reserves and surplus of A and B Limited will be taken over by AB Limited. Whatever is possible to be taken over, everything they will take over and show. Because this is just a reorganization. That means, what about share capital, sir? Sir, share capital you cannot show because share capital belongs to A Limited. Now, is A Limited there or closed? Closed. If company itself is not there, the closed company ka equity share capital can new company take over and show? No. So, share capital of A Limited we will not take over. Similarly, B Limited there or gone? Gone. So, B Limited ka equity share capital you will not show. Rather than that, AB Limited issued new shares. No? Instead of existing equity shares, new company will issue new shares. So, only thing that will come as a substitute is what? New equity share capital or new preference share capital. Old equity share capital, old preference share capital will get cancelled. Instead of that, new will come. Rest all assets, all liabilities, all reserves and surplus will be taken over by new company and accounted at book value itself. That is your merger method. Easy. Understood? Can we move on to the next one? So for merger method also, if you remember, I had given you some steps. First step is easy, sir. Same thing, which is PC. No separate thing at all. PC calculation is same. Okay, if PC is missing, calculate net assets and that itself becomes PC. That is one. Okay. Sometimes they'll only give you the PC. Find out that. Second, sir, in previous method, what did we compare? PC with net assets. How did you calculate net assets? Asset minus liability. Okay. Now here we can't compare PC with net assets because only assets and liabilities are taken over or also reserves and surplus. In merger method, assets of selling company, outside liabilities of selling company and reserves and surplus of selling company is also taken over. What is not taken over or what is the only thing that is not taken over? Paid up capital. Yes, no. Paid up equity share capital and paid up preference share capital. So PC, no sir, you compare it with paid up capital because that was the only thing that was not taken over. Okay. So it was not taken over means you just check what is given instead of that. Paid up equity share capital was 10 lakh. Let's say selling company had only paid up equity share capital of 10 lakh. So ideally, new company also should issue preference equity shares worth how much? 10 lakh. Usually it will be same because do you think this is really business purchase or reorganization? Reorganization. That means the PC value and paid up capital value will be usually same. But for question's sake, they may alter it. Okay. So what you do is first find out PC and then find out paid up capital. Paid up capital we need to find out or just take it from balance sheet. They will give you balance sheet, not paid up equity share capital. Paid up capital here refers to paid up equity share capital and preference share capital. It will be given to you in the question. Sum it up. Let's say this is 1 lakh, this is 80,000. Assumption. This is 1 lakh and this is 80,000. Now compare these two. Compare these two. How much is PC? 1 lakh. How much is paid up capital? 80,000. Now here paid up capital, for your understanding purpose, you can treat it as net worth. Don't tell I told this. Only for the sake of comparison. So how much was the worth, sir? 80,000. Because this 80,000 is the only component which new company is not taken over. So that means this is the 80,000 is the worth. So ideally for 80,000 worth, you should have paid only 80,000. But how much did the new company pay? 1 lakh. So for 80,000 worth of business, the new company paid 1 lakh. So new company made a profit or they made loss? Loss. How much loss? 20,000. Okay. So this 20,000, don't account it as goodwill. You adjust it in the reserves. Because here in merger method, will we take over only assets and liabilities of selling company or even reserves in surplus? Reserves in surplus. So this 20,000 in my example, loss, no, it will be adjusted in reserves. So which reserve? Usually in general reserve. Usually, not necessary. You can adjust it in general reserve or P&L, it's fine. Okay, na Saru? So why can't we account it as goodwill, sir? Sir, if you account it as goodwill, it will become self-generated goodwill. If you account it as goodwill, it will become self-generated goodwill. How, sir? Sir, what is self-generated goodwill, sir? You know, in your bachpan, in your 11th grade or 12th grade and all, you calculated goodwill under average profit method, super profit method, annuity method, capitalization, blah, blah, blah and all. Did you pay any money for it or it was just an internal calculation? Internal calculation. All those are self-generated goodwill. Now you think logically, the legal papers may say AB Limited has acquired A Limited and B Limited. That's what papers will say. But reality is it really a business sale or just a reorganization? It's just a reorganization. Whatever data A Limited and B Limited had in two different companies, now it has come in one new company. That's all. So is this really a sale of business? No. Now, if you account this as goodwill, it will become self-generated goodwill because it is not really a sale of business. It is just a reorganization. Hence, we don't account it as goodwill. Rather, we adjust it in the reserves. Understood? That is the logic. Fine. This is the case of loss. If PC is greater than paid up capital. It could be other way around also. Like suppose a PC is 2 lakh. This is 3 lakh. PC is 2 lakh rupees. This is paid up capital is 3 lakh. So worth of the company, selling company is 3 lakh. Paid up capital is 3 lakh means here that only we are thinking as net worth and doing the calculation. So worth is how much? 3 lakh. PC paid is how much? 2 lakh. So purchasing company made a what, sir? Loss or profit? Profit. Ideally, in my opinion, that profit should have gone to capital reserve. But our ICA study material, our mother body, okay, amazing body, they're transferring it to P&L. So going forward, you also do the same practice in exam. There's one change. Is that okay? Don't transfer it to capital reserve, transfer it off to P&L. In my view, it should have been capital reserve, but what I think has no 2 cents ka value. What study material says, that's all we need to do. This is only for merger method. Okay. Purchase method same. Only in merger method, instead of transferring it to capital reserve, transfer it off to P&L. Okay. Fine. Okay, sir. This is one change. Is that okay? So that means where in all entry you had capital reserve in merger method, substitute with the P&L account. Our mother body is doing. So I will not question the judgment of it. Okay. So I'll just move on and do the same practice. Fine, people. In my opinion, this is wrong. Even in India's CA final also, India's 103. It's okay. Okay, there's some extra pointers which we should not do this. Okay, but still, let's not worry about that. First, we need to pass CA intermediate and then come to CA final. So we'll worry about CA final when we come to CA final. For now, what is the main change there? Loss means adjust it in reserve. Profit means don't transfer it to capital reserve, transfer it off to P&L. Okay. If study material changes, I will also change. For now, let it be like this. They have not changed, so I will also not change. Okay, now that is the fun. And which method? Only for merger method you will do this. Purchase method, whatever we discussed, is the same thing. Now, one more thing if I have to call out in merger method. What and all relating to selling company will be taken over by purchasing company? What and all of selling company will be taken over? Assets, liabilities and reserves and surplus also of selling company will be taken over and shown by the purchasing company. Obviously, at what value? book value itself. In purchase method, we only take over assets and liabilities because it's an actual business purchase. And when you purchase someone's business, you are only interested in assets and liability. Merger method is not actually a business purchase. It is only a reorganization. Hence, we take over assets, liabilities, and reserves and surplus only at book value and record. Done, are people? That is the steps. Okay. Some extra fittings will come in amalgamation. Quickly, we'll run over them and then we'll apply everything in questions. Okay. Because we're not doing normally the way we did in class was first we did purchase method, then we applied some problems, merger and some problems, and all we did. But now we are not taking one problem. We'll take one problem which has some good adjustments. So that's the reason we need to know all the adjustments first, and then we will apply it in some questions. Okay. Don't worry about the number of what questions we are picking up and whatever may be the question. In some attempt question will be very straightforward. In some question the question will be like, what the hell is this question? That kind of a question will come. Okay. So we have to just prepare at a medium level. It's fine. Okay. One or two, always go with the mentality that one or two questions in your paper will be a bouncer. Doesn't matter how many RTPs you do, MTPs you do. I'm not demotivating you. This is a fact. Take any attempt for that matter, any paper, one or two question will always be a little out of the box. So because of that out of the box question, don't freak out. Everything is not out of the box. 70 to 80 marks is well within your study material RTP, MTP. Out of that 70, 80, try to score. If they've given you like 70 marks, try to score 60 in that. Because these are papers where if you write properly, you should get full marks. So there, if you score even 55, 60, in other bouncer question, I'm saying bouncer question with choice. Because you will get one choice question also, no? So around 30, 40 marks if it comes as a bouncer question. Even if you score 3 marks in that, 2 marks in that, 5 marks in that, extra, bonus, WOSI, free, we will take it happy. 60 here plus 5, 6 there, 70 crossed. CA inter passed. We are in CA final. Goodbye CA intermediate. Like that. Okay, so don't freak out. That's how everyone has cleared. You will also clear like this. Okay, some paper will go in your favor. Some paper you may get a little stuck. But one will compensate the other. So do not ever give up. And do not ever value. After you write the paper, that paper is dead for you. Move on to the next paper. Aram say it will happen. Don't worry. CA is not as difficult as people project it to be. It is very, 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 very not very, very easy also. But yeah, it is decent enough. That's what I would say. Okay. Next is your mutual owings. Sir, mutual owings means intercompany transactions. If purchasing company and selling company, if they are doing some transactions, that intercompany transaction only, we call it as mutual owings. Now let's take an example here. Sir, A Limited is there, B Limited is there. A Limited has sold some goods to B Limited. And A Limited has not yet collected the money. So how much money? 1 lakh. A Limited has sold goods to B Limited, goods worth 1 lakh and collected or not yet collected? Not yet collected. So obviously A will show this as what? Debtor. B will show this as what? Credit. Yes, sir. Sir, as long as A Limited is a separate company, B Limited is a separate company, one company can pay the other or one company can receive from the other. Now, you know what happened? Due to Vastu, these two companies merged and became C Limited. These two companies merged, meaning they shut down and they became C Limited. Correct? So under merger method, what do you do now? All the assets of A Limited, you will transfer it to C Limited. All the assets of B Limited, you will transfer it to all the assets and liabilities and reserves and surplus of B Limited, you will transfer it to C Limited. That means this debtor and creditor also got transferred to C Limited. Sir, as long as A was a separate company, B was a separate company, one could pay the other. Now there are two companies or only one? Only one. So who will pay whom? Are there two or only one company? One company. Who will pay whom? Nobody. Hence what we have to do? Such mutual owings you should be cancelled. Where it will get cancelled? In A ka books, B ka books or C ka books? C ka books. Because as long as there are two companies, one can pay the other. Only when they became one, then only you need to cancel because nobody will pay the other. Or another way if you have to explain, all assets and liabilities will be added. No, sir. This debtor has a debit balance. If you add it with creditor ka credit balance, its balance will become 0. Nobody will pay the other. You're showing asset also 1 lakh. You're showing liability also 1 lakh. So it'll get squashed off. So no need to show. If you show this asset and show this liability, unnecessarily asset side will get boosted. Hence, what do we do for such transaction? We need to cancel. Mind you, cancellation will not happen in A and B Limited ka books. It will only cancel in or it will only get cancelled in C Limited ka books or new company ka books. So in selling company ka books, you don't have to do anything for mutual owings. Cancellation will only come in the books of new company. Understood? On to the next. Sir, this mutual owings, no, usually it will come in three formats. Debtor, creditor. One is debtor, creditor. Another form is bill receivable, bills payable. Another one could be loan taken, loan given. Oh, not written here. Okay. Loan taken, loan given. Usually these are the three forms in which you get some mutual owings. Now those mutual owings can be show in C Limited ka books or cancel. So cancel only asset or also liability. This asset also you need to cancel. This liability also you need to cancel. In whose company ka books? C Limited. First C Limited will take over. First C Limited will take over this asset, will take over this liability. And then you pass a separate journal entry for cancellation. Because to cancel something, C Limited should first account it. Correct? No? Hence this 1 lakh C Limited will show first as a debtor. This 1 lakh C Limited will show it as a creditor. Then both this debtor and creditor will be cancelled. How do you cancel? What is a cancellation journal entry? Liability and assets, both you need to cancel. Liability has credit balance. To cancel, we will debit. Asset has debit balance. To cancel, we will credit. So the entry is basically all liabilities you debit. Liabilities could be what, sir? Debtor, bills pay, or creditor, bills payable, loan taken account will be debited. Sir, if there are three mutual owings, don't pass the entry like this. This is just a sample entry. If there are three mutual owings, pass three separate cancellation entries. This is just a sample I've given. Basically, all liabilities will be debited. All assets will be credited. Assets could be what? Debtor, bill receivable, and loan given. So this is your cancellation journal entry, mind you, in the books of new company only. That's about mutual owings. I'll move on to the next one. Great. Next is stock reserve. Stock reserve. Stock reserve means some profit. The very word of stock reserve means some profit element included in closing stock. Some profit included in closing stock only we call it a stock reserve. So how can it come? Let's look at this example. Sir, A Limited had sold goods to, or let's say A Limited acquired B Limited. A Limited purchased of B Limited ka business. And A Limited has sold some goods to also to B Limited. Possible, no? They can have some transaction also with themselves. Okay. Sir, cost price. If first to sell the goods, A Limited should have purchased these goods first. A Limited purchased these goods for 10,000. First they have purchased it for 10,000. Later they sold it for B Limited for 15,000. They purchased it for 10 and they sold it later on to B Limited for 15. So did A Limited make any profit in this transaction? Yes. How much profit? 5,000. Okay. So now who has the goods? The other company, B Limited. How much did they buy it for? 15,000. Selling price of one company becomes cost price to another company. If A sold for 15,000 means B purchased it for 15,000. Suppose B purchased and the year got ended. After purchasing, B wanted to sell these goods. But before sale, the year got closed. So in year end, does B Limited have this stock in their factory? Yes. That means B Limited will show the stock as what? Closing stock. So now A Limited has acquired B Limited. A Limited has acquired B Limited. That means whatever B Limited assets, now again we'll come back to which company? A Limited. First A Limited had sold some goods. After this transaction, A Limited acquired B Limited ka business. So if A has acquired B Limited ka business means all B ka assets and outside liabilities will be coming back to A Limited. So this closing stock also will come back to A Limited. Now, people, touch your heart and tell, is the value of closing stock from A Limited perspective 15,000 or lesser? From A Limited, because this is whose stock? Is this a new stock or belonging to A only? First, A only had sold this to B, no? Now it has come back to A only. Look at the circle of life. It went like this, again came back to you only. So first you sold it for 15, again it came back to you. Now from A Limited perspective, is the cost of the goods really 15 or only 10? Only 10. But currently B Limited is showing this stock, closing stock at what value? 15,000. So when A Limited prepares their balance sheet, can they show the stock at 15,000? Would that be right? No, because really the cost of this goods is not 15, it is only 10,000 rupees. Okay. Sir, how much is the extra? Worth of this goods is 10, but currently it is shown at 15. So how much extra? 5,000. That 5,000 is nothing but the profit element included in closing stock. That only we call it as unrealized profit. Can we show this unrealized profit or eliminate? Eliminate. Or if you want to go back to another one, you have done AS2, Accounting standard 2, what does accounting standard 2 says? Inventory to be valued at cost or NRV, whichever is lower. Forget about NRV information missing. Usually NRV will be higher than the cost in absence of information. So inventory should be valued at cost. Is the cost 2? Now we are treating A and B as separate companies or one companies. After purchase, they become one company. So from that one company perspective, is the cost of these stock really 15 or only 10? Only 10. That means this closing stock should be shown in the new balance sheet only at 10. But currently it is shown at 15. So hence some 5,000 extra profit element is included in B Limited ka stock. Can we show that or eliminate it? Eliminate it. That elimination only we call it as unrealized profit. Okay, Nasaru? So keep in mind, unrealized profit means profit included in closing stock. Okay. Now, this is treatment is right, provided 100% of this goods is there with the B Limited. Yes, no. First, B Limited purchased, and if they sell this goods or 100% is remaining. If 100% is remaining means 100% of profit you eliminate. Do you think every case may B Limited will have 100% of this goods, or some they would have already sold also? Some they would have sold also. Like let's reconstruct this example and say B Limited sold off 80% of these goods. B Limited, or maybe let's take simple example, 50% they sold off. B Limited sold off how much, sir? 50%. That means its entire closing stock there at 15,000? No. This closing stock of 15,000 is for 100%. Is entire goods remaining or only 50%? That means B Limited will show closing stock at what value? Not 50,000, but only 50% of 50,000, which is 7,500. Agreed on? Okay, sir. Now, who is showing this closing stock? B Limited. Who acquired B Limited now? A Limited. That means this closing stock again will come back to which company? A Limited. Okay. Now, the problem is the cost of this goods really 7,500? No. So this cost of 7,500 is for 100% or 50%? 50%. How much did A Limited purchase it for? 10,000. This 10,000 is only for 50% or 100%? That means what is the cost of this goods really? 10,000 is the cost of the goods for 100%. For 50%, how much it will be? 5,000. So the cost of this goods really from A Limited perspective is not 7,500. It is only 5,000. But currently B Limited is showing it at 7,500. That means have they included some profit in closing stock? Yes. How much profit is included? 2,500. Or in layman terms, how much was the total profit? 5,000. 5,000 is for 100%. Is 100% of the goods remaining or only 50%? That means you simply take 5,000 and multiply 50%. How much are you going to get? Same 2,500. Either you can arrive cost separately, closing stock value separately, compare and then get unrealized profit, or straight away do this proration. That way also you will get it. So this basically 2,500 can you show or you need to eliminate? You need to eliminate. From what? This profit element is included where? In closing stock. So that means closing stock is shown less or shown more. Some profit is included in closing stock. So closing stock value is shown more. What we have to do? Reduce it. So closing stock is an asset, has debit balance. How do you reduce it? Credit it. Yes, so you will credit, either you can credit stock reserve or you can directly credit closing stock. The choice is yours. Even if you credit stock reserve will be finally reduced from closing stock itself and balance sheet. The choice is yours. So, but the funda is closing stock has to be reduced means you will credit closing stock. What will you debit? What will you debit? Sir, that depends on the method and that depends on the case. Meaning whether it's a profit scenario or whether it is a loss scenario. Understood the meaning? So if there is unrealized profit, we need to eliminate. So closing stock value we need to reduce. So closing stock you will credit. The only question is what you will debit. That depends on the method. That's what I've summarized over here. First, you need to check whether it is a purchase method or merger method. Sir, if it is a purchase method, you could have one of the two scenarios, either profit or loss. Sir, under purchase method, if you make profit, what do you call that as? Purchase method. Under purchase method, if purchasing company makes a profit, it's revenue profit or capital profit? Capital profit. All capital profit will be shown under capital reserve. So what will you debit? For this stock reserve, you will use capital reserve. So the journal entry will be capital reserve account debit to closing stock, or you can write stock reserve. Even if you use stock reserve, the stock reserve will be finally reduced from balance sheet under closing stock itself. The choice is yours. Fine, sir. This is about profit scenario. It could also be a loss scenario. So if it is a purchase method and if you get a loss, what do we call that loss as in purchase method, goodwill. So the entry for stock reserve will be goodwill account debit to stock reserve or goodwill account debit to closing stock. That is the entry. This is for purchase method. You could also have another method called merger method. And a merger method, profit scenario, ideally it should have been capital reserve, but our mother body says P&L. Our mother body is always right. So what will be the entry for profit scenario? It will be capital reserve to stock reserve. No. It will be P&L account debit to stock reserve. Okay. This is one recent change. That's the reason our study material is showing, the chart book is showing the old entry. So correct this. So P&L account debit to stock reserve. That is one. However, if it's a loss scenario, if it's a merger method and if it's a loss, we call that loss as goodwill. Now, if you show it as goodwill, it becomes self-generated goodwill. So what do we do for loss? Adjusted in reserve. So the entry will be here, reserve account debit to stock reserve. So which reserve? Either general reserve or P&L. General reserve or P&L account debit to closing stock or stock reserve will be the entry for this particular scenario. Can I move on? Okay. So how many more? One or two more and then we'll dive into the problems. Chapter not over. Only concept over. Yeah, big ticket topic. Now we have to spend some little time on this. Okay, hope it's helping out. Online also, everybody there. I know some part of time. Not so much also. I think 12:50. That's fine. Yeah. Here also okay, everyone. Next is amalgamation expense. So when you do some amalgamation, no, you will have some expenses. Like you may have to hire some auditors to do the due diligence audit. Because if you're buying one company ka business means you can't buy it left, right, center. No? What if that company has done a lot of gapla, fraud? You want someone to check that, no? So normally in these sort of transactions, we do something called due diligence audit, where we check whether the transactions are in the right manner. Not like a normal audit, little deep dive we'll do. Because we are doing this for business purchase perspective, no? So we'll go a little deep dive and check the things. So this auditor for due diligence and all, he will charge it, he will do it at free of cost, or company has to pay money. Company has to pay money. And one company is merging the other company means it is not a small affair, right? Two companies are shutting down. So many people will be involved. Some ROC filings has to be done. So you may have to appoint a lot of consultants, could be company secretary, could be investment bankers, a lot of people. All these people will not obviously work it at free of cost. They will charge some money. All that we call it as what's sir? Amalgamation expense. So if amalgamation expense, if it is incurred by purchasing company, not selling company. Selling company, what to do? We'll see it later. If amalgamation expense is if it is incurred by purchasing company, we need to pass one entry. What entry should be passed? Sir, easy, sir. You credit bank account, sir. Yeah, you paid money, so you will credit bank account. The question is, what will you debit? So that depends on the method, that depends on the scenario. Okay. So if you have amalgamation expense, first check whether it is a purchase method. If it is purchase method and if you get profit scenario, under purchase method, what do we call profit as? We call capital reserve. So the entry for amalgamation expense will be capital reserve account debit to bank account. Okay, instead of P&L to bank, it will become capital reserve to bank account. However, if it is a purchase method and if you got a loss scenario, then the entry will become goodwill account debit to bank account. That is the entry. This is under purchase method. You could also have some merger method. So if it is merger method and if you encounter a profit, will you write capital reserve to bank? No, you'll write P&L account debit to bank account. Okay, that's for the merger method and profit scenario. Next will be for you have a merger method and you encountered a loss. In that case, loss will adjust it in reserves. So the journal entry will be reserve account debit to bank. Usually for this we'll use P&L itself. Expense, no. So usually study material under merger method for this entry they will write P&L to bank code. In my opinion, even if you use general reserve to bank, it should be fine. Done, sir. This is for amalgamation expense. The last but one concept is statutory reserves. The adjustments, or all this will come in your adjustments. We will not have time to cover all the questions. In every question, all the adjustments will not be there because amalgamation as a topic is little lengthy. So what study material does is one adjustment, they'll put it at one problem. But if I do one problem, then some part of time will go off. Okay, I'll have to get it. So hence what I'm doing is all the concepts I'm discussing. All this will come as an adjustment in your problem. So all this one entry you have to go on passing. So if you understood this means the adjustment also indirectly already, no. We don't have to do that adjustment at all. So that means you would skip question answer, I will do. But few, not so many as we used to do it in regular class. That's what I told in the first, the beginning also, no? Same, fine. All right, so statutory reserve. what is the adjustment they will give in the question is, they will say, sir, statutory reserves of the selling company has to be taken over by the purchasing company. Statutory reserves of the selling company has to be taken over by the purchasing company. Sir, visualize. Normally, reserves and surplus of the selling company will purchasing company take over under purchase method. Sir, purchase method is a normal business purchase. When you do a normal business purchase, you only think, if you buy someone's business, are you interested in their reserves or only assets and liability? Assets and liability. Reserves of them, you are not interested, correct? But one reserve, statutory means it's a law requirement. Requirement of a law. So as per law, other reserves you are not interested, you are not taking over, it is fine. But one reserve specifically you need to take over and show. That we call it as statutory reserve. Usually it will be investment allowance reserve or export profit reserve. They'll clearly call out what is statutory reserve. Usually it will be export profit reserve or investment allowance reserve. All this is created as per Income Tax Act. They will call it out. So if this you have to account it. Can you get away with this, or you have to account? You have to take over an account. You have to take over an account. That means you have to pass an entry for this. So if it is purchase method, what is the entry you will pass? Some reserve you need to take over, sir. Reserve has what balance? Credit balance. You have to take over and account it now. That means you have to show this reserve. Purchase new company has to take over this reserve and show it in their books. So that means they will debit reserve or credit reserve. So if they debit reserve, this reserve will have a debit balance and you have to show it on the asset side of balance sheet. Will you show reserves on the asset side of balance sheet or liability side? Under shareholders funds, you show the reserves. Yes, no. So what is the journal entry to take over the reserves in case of purchase method? Reserve account will be credited. Whichever reserve you are taking over. Suppose you are taking over export profit reserve. You will credit export profit reserve. You have to debit something. The debit will be given to some dummy called amalgamation adjustment reserve. Amalgamation adjustment reserve account. So the entry for statutory reserve taken over under purchase method is amalgamation adjustment reserve account debit to respective statutory reserve. Statutory reserve need not be one, it could be more than one also. If there are two statutory reserve, credit the two statutory reserve given in the question. Debit will be given to amalgamation adjustment reserve, like that. Okay, sir. So amalgamation adjustment reserve, you have debited it. So this particular amalgamation adjustment reserve will have a credit balance or debit balance? Debit balance. So it has debit balance means don't show it on the asset side. It is still what? A reserve. Reserve you never show it on the asset side. But it has what balance? Debit balance. Hence you show this as a negative in balance sheet. In your balance sheet, you will show this amalgamation adjustment reserve in balance sheet itself under the heading reserves and surplus itself, but as a negative. Why? Because it has debit balance. That's the reason. So indirectly, if you think about it, let's say statutory reserve is 1 lakh. Let's say statutory reserve is 1 lakh. So under the reserves and surplus, what will happen is statutory reserve will be shown for 1 lakh. Okay. Then that's all. One more is there. Amalgamation adjustment reserve is also there. So you will write here amalgamation adjustment reserve as negative 1 lakh. So effectively reserve balance became nil. So this way you took over also. You are not showing also. Both are taken care of. That's all it is effectively. Okay. This is for which method? Purchase. Sir, statutory reserve you have to take over under merger method, sir. What entry, sir? Super duper entry, sir. Which is what, sir? No entry, sir. Why, sir? Under merger method, any which way, all the reserves and surplus of selling company are already taken over. So all the reserves is taken over means general reserve, P&L, security premium, statutory reserve, everything is already taken over. Again, for statutory reserve, you have to pass one more entry, not required. Because any which way all are taken over. For specifically for this, no extra entry is required for merger method. That is the reason. Move on to the next. Yeah. Okay. So till now we discussed what to do in the books of purchasing company. For various method, various adjustment. The last drama is what to do in the books of selling company. Okay. Any normally combo questions comes in examination. Few treatments in the books of selling company. Few treatments in the books of purchasing company. Like that they merge and they ask it. So if you know everything, then it's easy for us to take up the questions and solve. So that way we'll be taking up, those sort of questions you can expect in exam. So first, sir, selling company, they are a shutdown. Selling company, they are a shutdown. So whenever a company shut down, you have done this. Whenever a partnership firm shut down, you used to prepare something called realization account. Same here also. If selling company is no more means they have to prepare something called realization account. So basically the whole drama of selling companies, every single damn ledger has to be closed. Because selling company is no more, so every single ledger has to be closed. One easy way to close many ledgers is by preparing realization account. In realization account, the first step is transfer all the assets to realization account at book value. So why book value, sir? Sir, what is the intention of selling company? To shut down their assets, shut down all the ledgers. Assets ka ledger is shown at agreed value or book value? Book value. So the intention of selling company is to shut down the ledgers. If ledger ka balance is shown at book value means cancellation also will be done at book value only. So all the assets will be transferred to realization account at the book value itself. So assets have what balance? Debit balance. How do you cancel them? Credited. Where are you transferring them to? Realization. So what is the journal entry? Realization account debit to assets account. Okay. Sometimes instead of ledger account, they'll ask you journal entries. So always whenever you're doing ledgers, don't mug up. I've seen many people saying this comes on debit side, that comes on credit side, this to that, like that they'll do. Yeah, if you do it 3-4 times like that, your mind will register it. Even sometimes, even I also automatically with practice now, I know I don't even think on journal entry, automatically I put on debit and credit side because so much of practice is there. But you don't learn it like that. The reason for you is I can get away. I know it, I'm just saying. Alright, you can't. The reason is sometimes they may also ask you journal entry. So if you say this comes on debit side, then you'll have to visualize. You have to draw your diagram, so we know how good you are at creativity of your drawings and all. So don't get into all that stuff. Whenever there is a ledger, always practice the ledger or insert the components in ledger through journals only. So that way, whether they ask you journal or ledger, you will be able to solve it easily. So simple logic, asset has debit balance, to cancel we have to credit. So the journal entry will be realization account debit to assets account. All the assets are shown at book value, so cancellation also will happen at book value. So this is the entry. Only assets will be cancelled or also liabilities? Liability have credit balance. How do you cancel? Debit. Where will you transfer this to? Realization. So the entry will be all the liabilities account debit to realization. Since liabilities are shown in our books at book value, cancellation also will happen at book value itself. So hence all the liabilities will come on the credit side. This is one thing. Okay. The next way in your golden days, what we used to do, whenever a partnership firm used to shut down, all assets one by one we used to sell. All liabilities one by one we used to settle. But here it's individual piecemeal settlement or whole business sold. Selling company is not selling one of their assets. They sold their whole business. So this asset ka realization one by one, liability ka settlement one by one will not come here. Rather whole business you sold. Did the selling company sell this business at free of cost or they will charge money? Have they already received this money or yet to receive? Yet to receive. From which company? Purchasing company. That means from selling company's perspective, they have to receive money from purchasing company. So purchasing company is our debtor. Debtor will have creditor or debit balance. Debit balance. So that's the reason PC you have to show it on the credit side, because the journal entry is normally when you sell an asset individually, you used to pass the journal entry as bank account. What is the journal entry for sale of asset? Plant and machinery sold 1 lakh. Plant and machinery sold 1 lakh. What is the entry? Usually we write bank account debit to plant and machinery 1 lakh. But in your golden days, 11th, we never used to write bank to plant and machinery. We used to write bank to realization account. 1 lakh. Why? Sir, plant and machinery is already transferred to realization account. So that's ledger is already closed. So that's the reason when you sell the asset, you can't write a bank to plant and machinery. We write bank to realization because plant and machinery ledger is already closed. So for sale of assets, we do like this. When you sell the assets individually, you pass the entry like this. But are you selling the assets one by one here or whole business? Whole business. So did you receive the money? No, you will receive it yet. So instead of bank account debit to realization, we will write the purchasing company account debit to realization account. Okay, this is whatever value. Let's say we have to receive per PC worth 50 lakh rupees. So we will make our purchasing company as debtor. So hence the entry. So when you post this in realization account, where will the posting come? On the credit side. So we'll write here by purchasing company to the extent of purchase consideration. Is that okay, Saru? Fine. Now, later on, when you receive money from purchasing company, you'll pass the entry bank account debit to purchasing company. If they give us equity shares, means equity shares account debit to purchasing company. If they give debentures means debentures account debit to purchasing company. Like that, go on passing. First make them our debtor and then show the recovery portion. Like that. Yes, sir, Saru. Okay. So this is about asset transferred, liability transfer and PC recoverable. 3 over. Yes. Sir, is it necessary all the assets of selling company has to be taken over or some may not be taken over? Some may not be taken over. So let's say our mic, so nice mic, okay, purchasing company did not take over. So our company shut down. So will we keep this mic as it is or what will we do? We will sell it. Now this mic, was it taken over by new company or not taken over? Not taken over. So we will sell it. But this mic I've already transferred to realization account. So mic ledger is already closed. Now when I sell this mic, I will not pass the journal entry bank account debit to plant and machinery. What entry I will pass? Bank account debit to realization account because mic ledger is already closed. So the journal entry with this bank account debit to realization account. This is for the assets not taken over. Understood? Okay. For assets not taken over, you will get your golden days wala entry. This entry will come. Only for those assets which are not taken over. Similarly, you may have some liabilities which new company has not taken over. Some creditor of selling company, purchasing company told we will not take over. It's a negotiation. Anything could be taken over. Anything could not be taken over also. Creditors of selling company taken over or not taken over? Not taken over. I'm the selling company. I told the creditor, hey macha, purchasing company no, did not take over Yuda. I will not pay you. See you, tata, bye bye. And you went. What will he do? He'll pull you by the collar and say, pay Madi. Yes or no? Correct? So if purchasing company does not take over any liability, then selling company has to settle this liability individually. What is the journal entry for creditors paid 50,000 in check? Creditors to bank. But can you pass the journal entry creditors to bank here? No. Creditor ledger is already closed because you transferred it to realization account. So instead of creditors to bank, the entry will be realization account debit to bank account. This will be for what, sir? For any liabilities not taken over by the purchasing company. Okay. This one. And you could have some amalgamation expense. Is it necessary amalgamation expense has to be incurred only by purchasing company or it could also be incurred by selling company? Again, that's a negotiation. Sometimes maybe purchasing company will incur. Sometimes maybe selling will incur or sometimes maybe both will incur. Depends on what it is. So if selling company incurs any amalgamation expense, what is the journal entry for any expense? Expense to bank and P&L to expense. So if you add both the entries, effective entry for any expenses, P&L account debit to bank. Correct? For one expense, you want to prepare whole P&L. Not required. So for any expense, the journal entry here will be realization account debit to bank account. Instead of P&L account debit to bank, route it through realization itself. Because for one expense, it doesn't make sense to prepare the whole P&L like that. Okay. So if you have any liquidation expense is nothing but your amalgamation expense, or sometimes they may also call it as dissolution expense, whatever name they call it. If it is there, pass the entry as realization account debit to bank account, how much ever it is. Fine, sir. Sir, let's say selling company spent 10,000 for amalgamation expense. So the entry will be realization account debit to bank account. Purchasing company reimbursed 7,000. How much did selling company incur? 7,000. How much did selling company incur? 10,000. So the entry is realization to bank 10,000. After spending, is selling company keeping quiet or they're recovering? Part of this they're recovering from whom? Selling company. Purchasing company. How much are they recovering? Full 10,000 or only 7,000? Let's say they recovered 7,000 fully. That means what? When you incur the expense, what is the journal entry? Realization account debit to bank account. Later on, you will incur expense or you will get it back. Get it back. When you get it back, what will be the entry? When you spend, it is realization to bank. When it is reimbursed, ulta entry. It will be bank to realization account. So if you have any liquidation expense, reimbursement. So the entry will be bank to realization account. That way. Okay, Nasar? Fine. One more thing is before you close, normally you close this ledger, any balancing figure in realization account represents realization profit or realization loss. In case of dissolution of partnership firm, realization profit used to transfer it to owners, and owners in partnership firm was the partners. So whatever profit you used to get, you used to transfer it to partners capital account or current account depending on scenarios. Yes, no, sir. Here, who is the real owner of the company? There are two owners, preference shareholders and equity shareholders. But preference shareholders ka money is fixed, no? Who are the guys who take the real risk in the company? Equity share holders. So realization profit or loss will be transferred to equity share holders account. Okay, whether it is profit or whether it is a loss, both will be transferred to equity share holders account. But before that, check. Does the selling company have any preference share capital? Some problems they will have. Selling company will have some preference share capital. Let's say selling company has a preference share capital of 1 lakh. Okay. So whom you have to pay this preference share capital to? Preference share holders. Okay. So let's say preference share capital is 1 lakh. So this preference share capital ka ledger balance can you show or you need to close? Every single ledger you need to close. Not even one single ledger should have a balance in selling company books. Preference share capital, how much balance? 1 lakh. Share capital will have credit, debit, what balance? Credit balance. Whom you have to pay this capital to? Preference share holders. So share capital has credit balance. To cancel, we will debit. So what is the entry? Preference share capital account debit 1 lakh. Whom we have to pay this to? Preference share holders. So in preference share holders account, you'll write by preference share capital 1 lakh. Agreed? I'm preparing preference share holders account. Same will come in one of the questions, but quickly saying. Yes, sir. Yes, sir. But purchasing company paid to preference shareholders 1,20,000. It's a negotiation, right? They may pay 1 lakh, lesser than 1 lakh, or higher, more than 1 lakh. Let's say preference shareholders, they got some new preference shares. Preference shareholders got some new preference shares. They did not get cash, they got some new preference shares. But the preference shares ka worth is how much? 1,20,000. Possible? Ledger matching? No. How much difference? 20,000. Correct? So means this is a loss. This is a loss. No, sir, this is a gain. Yeah, this is the gains for preference share holders. But for equity shareholders, full tripti toss. Correct or no? So this balance 20,000, you will transfer it off to realization account. Because for preference shareholders, it's a gain. But for equity shareholder, it becomes a loss. Because if preference shareholders takes more money means, for equity shareholders, it will be less money. So from their perspective, it will be a loss. So any balancing figure in preference shareholders account, you transfer it to realization account. What will be the posting of this? Can you tell me? This entry ka posting. Realization account debit to preference shareholders account. That's what I've written here. Done. This entry will only come if you pay more money to preference shareholders. That's what I've written here. If amount paid is in excess of preference share capital, then only this entry will come. Otherwise, it will not come. Okay. So if you paid less means, instead of posting it on the debit side, post it on the credit side. Basically, balancing figure in this account, you transfer it to realization account like that. Okay, Saru. Check. Every problem, it may not be there. Some problems may, this adjustments also have been tested. After doing all this drama, any balancing figure in realization account represents realization profit or realization loss transferred to the true owner, and true owner here is equity share holders account. Balancing figure, you transfer it to equity share holders account. So with this, all the assets, all the liability ka ledger is closed off. Okay, but few ledgers still have balance. Reserves and surplus, equity share capital, equity shareholders, all these are there now. So next account you prepare is something called equity share holders account you prepare. As a checkpoint, I have given you 6 components in class. Do you remember? Equity shareholders get 6 components, or 6 components will be transferred to equity shareholders account. One is equity share capital, all the reserves and surplus, a preliminary expense, deferred revenue expenditure or miscellaneous expenditure if any, realization profit or loss if any, PC if any, surplus cash if any. I told you, you can keep it as checkpoint if you are big on memory. Some people are big on memory. They want to remember like this and test it. If you are like that, I'd given you 6 points. Or if you want to approach logically, simple. Where will you show equity share capital under? Visualize balance sheet. Where will you show equity share capital under? Shareholders funds. So equity share capital belongs to whom? Equity share holders. Equity share capital has what balance? Credit balance. You have to transfer it to whom? Equity share holders account. Equity share capital has credit balance. To transfer, we will debit. So the entry will be equity share capital account debit to equity share holders. So that's the first thing equity shareholder will get. Share capital. Where do you show reserves and surplus in balance sheet under? Again under shareholders funds. Preference shareholder is already settled. So this reserves and surplus still has a balance. Reserves and surplus also is a shareholders funds, meaning reserves and surplus is also an entitlement or is something which is belonging to whom? Equity shareholder itself. So all the reserves and surplus, whatever you have, general reserve, P&L, CRR, DRR, blah, 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 whatever, every reserves and surplus will be transferred to equity shareholders account. All the reserves usually will have what balance? Credit balance. To cancel, what we have to do? Debit. So all the reserves will be debited one by one. Credit will be given to equity shareholders account. So this way, these two ledger account will get closed. Done now. Sometimes in the problem, there's an outdated adjustment. Check. Old questions where this used to come. If at all they give you preliminary expense, deferred revenue expenditure, miscellaneous expenditure and all, it will not appear on the liability side of balance sheet. It will come on the asset side of balance sheet. Most probably it will not come in the question, just in case it comes out of the blue. Then these components have what balance? Expense. No, sir. Expense will have, what does nominal account rule say? If you're confused about balance, obviously they will give you balance sheet. This you will see it on the asset side of balance sheet only. So that should be enough evidence for you. Still, if you're a pokey person, okay. Now, what does nominal account rule say? Debit all expenses. So obviously, expense should have what balance? Debit balance. Now, can we show this or cancel it? Every single ledger you need to close. It has debit balance. To close, what will we do? Credit it. Where will we transfer this to? Equity shareholders account. So the entry will be equity shareholder account debit to preliminary expense to deferred revenue expenditure, miscellaneous expenditure, if at all you have any. So this also will get closed. Yes, sir. This is one. And then you prepared realization account. What did you get? Either you will get realization profit or realization loss, which will be transferred where? To equity shareholders. That is what I've written here. Realization profit or loss. Sir, equity shareholders will only get this, or what is the main thing they are interested in? They agreed to sell this business of selling company with an intention of what? Recovering PC, money. Yes or no? So that means the next thing equity shareholder will get is the PC. In whatever format, maybe in the form of cash, maybe in the form of check, maybe in the form of equity shares, maybe in the form of new preference shares or debentures, doesn't matter. Whatever they receive, they will credit that. Or we will account it. Yes, sir. So our selling company closed, but selling company still has a cash balance of 1 lakh because they receive PC in the form of cash for 1 lakh. Selling company received PC from purchasing company in the form of cash. How much? 1 lakh. No expenditure. Everybody is already settled. So how much cash balance selling company still has? 1 lakh. Will they keep this idle or what will they do? They will give it to whom? The real owners. Preference shareholder is already settled. Who is the only one yet to be settled? Equity shareholders. So if selling company by chance has any surplus cash, if at all it is remaining, that surplus cash balance also will be given to equity shareholders account. So this is your checkpoint. One more checkpoint you need to keep is equity shareholders got debit side total and credit side total should match. This side is 1 lakh means that side also should be 1 lakh. If it doesn't match, go in the somewhere you have done some mistakes, check again. That's your final checkpoint. You should not have any balancing figure. That is the overall crux. Okay, sir. Maybe one more is there. Sometimes they will say PC is given in the form of based on intrinsic value per share. Intrinsic value. Do you know net assets? Yes. Sir, you got net assets of 10 lakh, let's assume. Okay. Now, net asset is belonging to equity shareholders. Net asset belongs to whom? Equity shareholders. Sir, this 10 lakh of net asset belongs to one shareholder or every shareholder? Every shareholder. Let's say the company has number of equity shares is 1 lakh. Total number of equity shares existing in this company is 1 lakh. How much is net assets? 10 lakh. So this 10 lakh belongs to one share or 1 lakh shares? This 10 lakh belongs to 1 lakh shares. If you own one share, how much will you get? If you own one share, how much will you get? How will you calculate that? 10 lakh divided by 1 lakh, which is 10. That to be called it as intrinsic value per share. Now construct your formula for me. Let's see. How did you calculate this? What is your 10 lakh? Net assets. What is your 1 lakh? Number of equity shares. That's your formula for your intrinsic value per share. Net assets divided by total number of equity shares. Okay, G. Yeah. Sometimes they say PC is exchanged in this format. That's the reason we may need to take the help of this. Okay. All right. Next is something called capitalized average profit. That I will take it in the problem only. If you want, you can remember it. One question I will do. Simply nothing but your profit after all the adjustments divided by rate into 100. Better understood with the help of numbers, which I'll take it. Next, sir, net assets is nothing but your shareholders' funds. It is nothing but your capital employed, different name. Okay, like just to give you an example, if you want quickly, sir, balance sheet. Let's say we have property, plant and equipment 1 lakh. We have current asset 50,000. We have current liability 20,000. Okay, so this is 150. This also should be 150. Let's say equity share capital is 50,000. Reserves and surplus is 80,000. Simple balance sheet I've constructed in T format. So can you tell me what is the net assets of this business? Let's say this is the balance sheet of X Limited. Can you tell me net assets of this business? How do you get net assets? All assets minus outside liability. What is the total of asset? Total assets? 1,50,000. Will you consider reserves and surplus or only outside liabilities? Only outside liability. Which is the only outside liability available here? I mean, how much are you getting? 1,30,000. Okay now. Sir, can you calculate shareholders funds for me here? What and all will you show on the shareholders funds? Equity share capital and reserves and surplus. Calculate 50 plus 80. How much is that? 1,30,000. Any different or same? Same. So another name of net asset is, sometimes in the problem, instead of net assets, they may use the term shareholders funds, or they may say capital employed. So capital employed, shareholders funds and net assets all are same. Different way of calculating. Net assets is calculated from asset liability angle. Capital employed is calculated using capital employed is nothing but shareholders funds angle. So if you calculate net assets from liability angle, we can call it as capital employed. Or you can also calculate it from asset minus liability angle. Doesn't matter how you calculate, final answer will be same. These are all different namakarana. That's all. Different aliases. They are all same. Okay, with this, chapter over or concepts over. All concept ka revision we have completely done. Now it's time for us to break. Nah. Problems. We'll do a little more. We'll finish off this. Another 20 minutes. This chapter will be over. Then we'll take a break and come back. I know Sapa time. One by one, slowly online people are going off. They're saying we'll watch it later on. But Papa, you guys, bicharas and some other guys, they're saying it's okay. We will adjust. Sometimes in life we have to adjust. Okay. This is not, if it was a regular class, more than you within 1.5 hours, 2 hours, I would have only given break. Okay. But now it's a case of a marathon class where you also have a shortage of time. I also have shortage of time because after this, so many people are asking FM marathon. Now see a final over. Now this over, that over. Yeah. So even I am also time pressed. So we'll try to finish. So he's saying when will you do that, sir? I'll do. First we'll finish this. I'll do it, but I'll tell you the time next week, sometime in April. Yeah, after April 7th or something, we'll schedule. Okay. It'll be posted on YouTube. You can subscribe so that you get notification or something, or you can call up the academy, or better don't call up. They're already bugged with the calls. They're not picking people's calls only now. Not purposefully. So many calls they're getting, Papa, they're not able to manage only. Yeah. Someone is saying books not received. Where is that? This, that, some purchase. Exam time is little kind of difficult for everybody, especially at coaching business. Every business they say has a peak season. No, exam season is peak for us. Those students are writing exam, no? We have to complete the syllabus on time. We have to revise. We have to do this. So it looks like more like I am only writing exam for my subject. Yeah, it looks like that. Same, how much of effort you are putting, I also need to put in the same efforts. Okay. That being said, can we quickly run over these questions? Some 2 or 3 questions I'll do, simple ones. Fatapat, we'll run through. Anyway, I've solved so that we'll not have to solve everything. We'll run through so that it should not take so much time as we used to do it. Okay. Yeah. Financial position of 2 companies they've given, Hari and Vayu Limited they've given. So same question, it's a study material question also. Same as that as your MTP question also this time. Okay, same. So they've given balance sheet. We know balance sheet is waste of. Okay. Just we'll be aware of the face value of each share. That is good enough for us. Then we'll directly dive into adjustments. Sir, Hari Limited absorbs Vayu. So Hari is a purchasing company. Vayu is the selling company. Okay. Following terms. 10% preference shareholders are to be paid at 10% premium by issuing 9% preference shares of Hari Limited. So, sir, does a selling company have how many owners? Check this. Vayu is a selling company. They have preference shares also. They have equity shares also. So, can you give the PC only to equity shareholders or both the owners? Both the owners. So, here preference share capital is how much? 1 lakh. Now check this line once again. 10% preference shareholders, that is this 1 lakh, are to be paid at 10% premium. So are you paying 1 lakh to them or 1 lakh plus 10%? That means you are paying them 1 lakh 10,000. Correct. Negotiation. You could pay more or you could pay less. Here you are paying more. By what? You can pay this 1 lakh 10,000 by paying cash, new equity shares, new preference shares, whatever. What is given over here? By 9% preference shares of Hari Limited. So it is a barter system. Old preference shares is getting cancelled. Instead of that, they want a new preference shares. So this 1 lakh 10,000 is not settled by cash, but by new preference shares. That is one. Okay. And one of the confusion which many students get is the premiums. Okay. Whether old preference shares have been paid more or whether new preference shares are issued at premium. That is one question. Sometimes it's little dicey because the structuring of sentence is little dicey in some of the questions. So one trick to identify whether old guys are paid more or whether new preference shares. Here, no sir, check here. How much is the preference share capital? 1 lakh. The question I'm trying to address is whether did you pay this 1 lakh by giving new shares at premium? Did you pay only 1 lakh by issuing new shares at premium, or did you pay 1 lakh did you pay 1 lakh 10,000 itself? Did you take over the old one at higher value and issue new shares at par? That is one. Did you take over the old shares at the premium and pay new one at par, or did you pay new one only at premium? That is a question. Some of them will face that. So one trick to sort out that is always check the word premium where it is inserted. This premium, no, check where have they inserted this word. Okay. So based on this, the treatment will vary. Always check if words premium, no sir, are used in the question next to old shares. If this word premium, if it is used next to old shares, then what it means is old shares are taken over at higher value and new shares are issued at par. So in this example, check. They said preference shareholders have to be paid at 10% premium. So this is your old. Next to that only 10% premium came. And then they are saying new preference shares are issued. So what this sentence means is you are not paying the preference shareholders 1 lakh. You are paying 10% more. How much are you paying? 1 lakh? 10,000. And this 1 lakh 10,000, how are you giving? By new preference shares. And that new preference shares are issued at par only. Why? The word premium is used here. Suppose they use this word premium after new preference shares. Suppose this word premium, no, if it is used after new preference shares, then that means is old shares are taken over at par value, but new shares are issued at premium. Like that you can decode. Because the word, when you read the sentence again and again, no, sometimes English meaning can give a slightly different way. But that's how it is interpreted in our ICAI question. So this, if you kind of keep in mind, you will not go wrong in your adjustment. Again, repeat it once for me. What is it? What did I say? If there is any premium element, check where is that word premium mentioned. If it is mentioned before new preference shares, say here what is coming first, premium or new preference shares? First premium word came, right? If the premium word comes before new preference shares, what it means is old one are issued at premium. Meaning you have taken over old at not at same value but at a higher value. And you are issuing new shares at par. Like that what it means. Suppose this word premium comes after new preference shares. Then it means new preference shares are issued at premium. Like check this word. Equity shareholders of YO Limited will be issued necessary equity shares at 5% premium. Now this word premium came where? Next to the old one or after new one? After the new one. So what does this mean now? New equity shares are issued at premium. Like that. So the word premium is the killer there. That is the driving point whether the new ones are issued at premium or not. So now is that clarity? Have you got an understanding? So keep this word and accordingly you will not go wrong there. Yes sir. Okay, now I'll go back to the question. I just read the last adjustment to bring in little clarity. That's all. Goodwill of YO Limited, selling company is 50,000. Building at 150, machinery at 160. So definitely it is purchase method. Why? Assets and liability. For it to be merger method, all assets and liability to be taken over at book value. Are they taking over at book value here? No. Check here. Building ka value. Come back to YO Limited. Building ka value is how much? 1 lakh. But it's taken over at 1 lakh? 50,000. So definitely it is a purchase method. It can't be a merger method because assets have been revalued. Even if one asset got revalued, definitely it will become purchase method. So purchase method. Inventory to be taken over at 10% less. Provision for doubtful debts at 7% you need to create. Equity shareholders of YO Limited will be issued necessary equity shares. Sir, they said the word necessary. How much given? How many equity shares given? How many equity shares have been issued is mentioned or not mentioned? Not mentioned. So what you give it to equity shareholders only is PC, no? So is this value of PC mentioned or not mentioned? That means indirectly what, sir? PC is missing. And if PC is missing, what to do? Find out net assets, and net asset itself becomes PC. What you gave it to preference shareholders was clearly given. But PC means what? Not just what you give it to preference shareholders. Preference shares mean, PC means what you paid to preference shareholders plus what you give it to equity shareholders. One component of PC was given, but other component relating to equity shares was missing. So hence the total PC also is missing. So if PC is missing, net asset is equal to PC. That's all. Okay, sir. So show necessary ledger account to close the books of Vayu. That is selling company ka ledger accounts you need to prepare. And acquisition entry and also balance sheet of Hari. After absorption, correct. So journal entry in the books of new company and balance sheet in the books of new company and selling company ka ledger they've asked. Combo offer. Maybe this will come for like 16 marks or something. Sir, doesn't matter whether it is selling company or purchasing company. One component both are interested in, which is what? PC. Correct. No, one will pay, other one will receive. So PC any which way you have to calculate. So PC is missing. So how do you calculate PC here? Net assets. Find out net assets, and net asset itself becomes PC. So net asset means how? Tell me, how do you get net assets? Assets take. You have to be very specific. Asset taken over at agreed value minus outside liabilities taken over at agreed value. That constitutes your net assets. Okay. Here few assets are revalued. I'll quickly run through them. First, check here adjustment. They have taken goodwill. No? Goodwill is 50, building 150, machinery 160. Taken one by one, we'll take off 50, 150, and 160. That's all. Now, what did they say next? Inventory taken over at 10% lesser. Come back to the balance sheet. What is the inventory ka value? This is Harika, this is Vayu ka. What is inventory of Vayu? 170. Josh, may don't take purchasing company ka inventory. PC is given to owners of selling company. So you need a net assets of selling company. Josh, may don't take Harika. Everything you would have done right. But PC wrong means all your ledger accounts are also wrong in the selling company books, because PC will affect your realization account. Realization will affect equity shareholders account. Everything gone. Based on PC only, you will pass journal entry in the books of new company. That is also wrong. So be careful. These are small mistakes which you should not do. Net assets here stands for net assets of selling company. Correct? No? So how much is inventory of selling company? 1,75,000. Is it taken over at 175 or 10% lesser? So 1,75,000 minus 10% you do, which is this. Correct? What about next? Debtors. Provision for doubtful debts, you have to make it at 7.5%. Means debtor you're taking over at that value or lesser value? Lesser value. What is debtor ka value? 1 lakh. 1 lakh minus 7.5% you do. How much is that? 92,500. That's what they've got. Okay, sir. That's all. Nothing they told about. That's all is asset, or we have one more. Sir, we have one more, which is cash. So if they don't mention anything about the other assets, take that over at book value. Okay. So if for assets, if they've given agreed value, take it over at that value. If they've not mentioned anything, assume that it is taken over at book value itself. So cash also will be taken over at 20,000. Taken up? Yes. This is your what? Net assets or total assets? Total assets. We want net assets. So what is one more we need to do? Deduct outside liabilities. What is outside liabilities in your balance sheet now? Check. Is long-term provision outside liability? They prepared note number 3. What is note number 3? Your gratuity fund. Yeah. Meaning gratuity payable. That is also liability, no? So 20,000 gratuity means you pay to whom? Employees. So outside liability only. This is one. Anything else is there? So this also will take over. What about trade payable? Yes. Anything else is there? No, that's all. So what is these two? 20 and 80 considered. Check in your PC working note. 20 considered, 80 considered. So total PC is how much? 5 lakh? 30,000. This PC will be given to whom? Owners of a selling company. Who are owners of selling company? Equity shareholders and preference shareholders. Sir, how much you gave to preference shareholders? Clearly I know. How? They only told. Equity shareholders or preference shareholders will be paid at 10% premium. Preference share capital in selling company was 1 lakh. Did we take over and paying them 1 lakh or 10% more? So how much we have to pay to the preference shareholders? 1 lakh? 10,000. So out of this 5 lakh 10,000 to preference shareholders, you will pay 1 lakh 10. So balance of 4 lakh 20,000, you will be paid to equity shareholders. Fine, sir. That's what they've given it. 110 and 422 equity shareholders. Yes, but be careful. Equity shareholders, no sir. What did you give? Equity shareholders of Vayu Limited will be issued necessary equity shares. So this 420 of PC to equity shareholders, are you settling by cash or new shares? New shares. But the new shares are issued at 10%, 5% premium. So this premium is coming after new equity shares. So what does this mean? New equity shares are issued at premium. Comfortable? Okay. So what is the face value of equity shares of Hari Limited, sir? 10. Okay, you can use whatever, it's fine. Face value is 10. It is issued at a premium of how much? 5%. So calculate 5% of 10, sir. 10 ka 5% is 0.5. Correct? That means the issue price is how much? 10.5. Do you agree with me? New company have issued their new shares at an issue price of 10.5. Face value is 10 given in the problem. Premium is 5%. Premium and all you'll always calculate on face value. So 10 ka 5% is 0.5. So the issue price is 10.5. Dana, you can take any value. If you don't want to work with 0.5 number, you can take it as 100. Because these are what, sir? Ratio apportionment. Even if you take 100 and finally work out also, final answer will be same. Okay, but here just check better to be safe side. Now, 1 second. Where is that number? I think I've already calculated. I think I've taken 100. We'll just rework this. Okay. Sir, this 4,20,000 is the total value paid. Sir, so here like this. Face value, issue price. If the face value is 10 rupees means issue price will be 10.5. That's what we got it last. This 4,20,000 is the face value or total value given? Total value given to equity share holders. That means this 4,20,000 represents issue price. If this is 420 means how much is that? So prorate this. How do you get X? 4,20,000 into 10 divided by 10.5. How much are you getting? 4. So in this 4,20,000, 4 lakh will be towards equity share capital. Balance will be towards premium. Premium will be 0.5 divided by 10.5. Or simply take 4,20,000 minus 4 lakh you do. You're going to get 20,000. So why we have to do? Sir, they asked you journal entry in the books of purchasing company. If purchasing company have issued shares at premium means you need to know how much premium has been issued and premium has to go to security premium. So calculate it now only so that it becomes easy for journal entry. Done. PC is received. So what selling company is interested is the total PC, which is how much? 5,30,000. Now close all the ledgers of selling company one by one. First step is what? Run me through. First account, which account you will prepare? Realization account. First step in realization account is to transfer all the assets at book value. Assets have credit, assets have debit balance. To transfer, we need to credit. So the entry is realization account debit to all the assets. Study material is giving a leeway approach. Ideally, in my opinion, each ledger has a separate balance, correct? No? So one ledger you need to close separately. But you know what study material is doing? What is the total assets? 570. You know what they did? To sundry assets, 570. If study material gives a shortcut, no, topic we should grab it off. Okay. In my opinion, ideally you should show all the assets one by one. That's what we have done in class also. But study material is saying you do it total, it's fine, we will accept. If they are saying we will accept, we will grab it. Okay, now. So instead of showing assets one by one, you show off the total. This is a total assets. Sundry assets is the total assets that they are talking about. Yes, standards also will be taking over. Don't worry. First, I'll finish off this. I have a specific target in mind. I'll cover. Leave the topics to me. I'll take care of it. Yeah. All right. First is this. Yes, this is assets transferred. Next is what, sir? All the liabilities transferred. I think we had only 2 outside liabilities. No, gratuity and trade payables. They have transferred off. Yes. What is the next step? PC. PC where you will have to receive PC from the purchasing company. Have you received or not? First, you will have to account the due entry. If you have to receive PC means the purchasing company becomes your debtor. So what will be the entry? Purchasing company account debit to realization account. So how much PC? 5,30,000. Okay, this is the entry. Okay, fine. But before you close here, is there any amalgamation expense? No. Is there any reimbursement of amalgamation expense? No. Any assets liability not taken over to be settled individually? No. If it is there, what to do? We have discussed. Hope you're comfortable. All that is not there. That means ideally balancing figure is realization profit or realization loss. But before doing that, always check whether the selling company has preference share capital. Does the selling company have preference share capital? Yes. 1 lakh. Did we pay them 1 lakh or did we pay them 1,10,000? That means how much more we paid? 10,000 more. If they paid 10,000 more means of our equity shareholders, it is profit or loss or loss. Sir, if you don't want the entry, if you don't have time to prepare preference shareholders account, you have time to prepare only a realization account. Now you want to bring in this adjustment. You're not sure whether it will come on the debit side or credit side. So realization account is like your trading P&L only. Realization account is like your trading P&L only. Sir, loss means it will come on the credit side of trading P&L or debit side. Debit side. You paid more to preference shareholders means for equity shareholder it is a loss. How much more did you pay? For 1 lakh of preference share capital, you paid 1,10,000. How much more? 10,000 more. So where it should come? Obviously on the debit side. Okay, now this is a formula. I wouldn't recommend formula, but in case sometimes what happens, we will not have time. So like that, you can quickly plug in these numbers because all this will carry 1 or 2 marks. So if you bring in this, no 1 mark extra you'll get, even though you don't prepare that ledger, because there's an important adjustment, because many students will forget this. That is the reason. So if you bring it in, you will stand out, and even though you have not done one other things, you'll get 1 extra mark for this itself. That's the reason. So quick assessment of that. So any loss, debit side. Any gains, credit side. Like that. Fine now. So then any balancing figure in realization account represents realization profit or realization loss. Here balancing figure, this balancing figure, okay, it's coming on the debit side. Now visualize your P&L account. Okay, if you're getting balancing figure on the debit side, means it is realization loss or realization profit. If you're preparing trading P&L, and if you show on the debit side what, sir? You show here 2 GP, no? In trading account, you show 2 GP. In P&L account, you show 2 net profit. So if you're getting balancing figure on the debit side, it means realization profit. So this is the case of realization profit. Like this also, they may give you MCQ. Balancing figure on realization account is coming on the debit side. Whether it represents realization profit or realization loss. Sir, MCQ, no, you can go literally crazy. Any which way you can structure. Okay. So that's the reason it is not possible to prepare for every MCQ, because you can build thousands of MCQ questions. You will have time to solve all thousands, huh? No. So you have to be conceptually clear. If you're conceptually clear, any MCQs you will tackle. If you're a mugging up kind, then it becomes a little difficult. Some you may get it, some you may not get it. But if you know what it is, aram se, most of them you should be able to tackle. So this is over. Next is preference shareholders account we will close. So preference shareholders account, what will they get, sir? Preference share capital. So preference share capital has what balance? Credit balance. How do you cancel it? Debit it. So the entry is preference share capital account debit to preference share holders account. So we'll post it as by preference share capital. That is one. What did you pay this preference shareholders? Cash. If you had paid cash to preference shareholders, the journal entry would have been preference shareholders to cash. But what did you give the preference shareholders? Some new preference shares. So the entry will be preference shareholders account debit. Don't write preference share capital. Sir, this is selling company books. Did selling company issue this preference shares or purchasing company? Purchasing company will account it as preference share capital. So here they will just write it as to preference shares of Hari Limited. Don't write preference share capital, you lose marks, because you will account it as capital. That company which is issuing preference shares, they will show it as capital. Here, this is in the books of selling company. Did selling company issue preference shares or new company? New company. New company will issue it as preference share capital. You don't show it. Okay. So you'll just write it as to preference shares of the purchasing company, which is Hari Limited. How much? 1,10,000. This side is 1,10,000. That side also should be 110. There is a balancing figure of 10,000. And balancing figure, you will transfer it off to realization account. That's what we posted over here. Done now. Any balancing figure in realization account represents realization profit or realization loss, which you will transfer to equity share holders account. Okay, Saru, that is one. Last account to be opened is equity share holders account. Equity shareholders get 6 components if you big on formula. That is equity share capital, reserves and surplus, miscellaneous expenditure, realization profit or loss, PC, surplus cash if any. As a quick checkpoint. So equity share capital and reserves and surplus have credit balance. To close, what we have to do? Debit it. So equity share capital account debit, reserves and surplus account debit. What will you credit? Whom will you transfer this to? Equity share holders account. So equity share capital debit, reserves and surplus account debit to equity share holders account. So what will be the posting in equity shareholders account? By equity share capital, by reserves and surplus. What are the reserves and surplus selling company has? Only one. Their equity share capital is 3 lakh. The reserve is 70,000. So you'll write here by equity share capital 3 lakh, by general reserve 70,000. Okay, na sir. 2 points done. Only one reserve is there. Third one, miscellaneous expenditure. Check. Do we have any miscellaneous expenditure? We read through. Did we find anything? No. Cut off that. Fourth one, realization profit or loss. We prepared realization account. You wrote realization account debit to equity share holders account. So in equity share holders account, what will you post it as? By realization profit 50,000. Fourth one done. Fifth one, surplus cash. Does a selling company have surplus cash or cash also was taken over? Selling company ka cash also was taken over by purchasing company. You consider that in PC also, no sir, at book value. So selling company does not have any cash because cash also is taken over by purchasing company. Okay, that is ruled out. Last one is what? PC. What did you give to equity shareholders? You already found out. How much did you give it to equity shareholders? 4,20,000. If you pay cash to equity shareholders, the journal entry is equity shareholders to cash or bank. How did you settle this 4,20,000? What did they say in the adjustment? Equity shareholders of Vayu Limited will be given new equity shares. So the entry will be what? Equity shareholders account debit to bank? No. You'll write to equity share capital. You'll write no. For the company issuing new equity shares, for them it is equity share capital. Who are issuing new shares? Purchasing company. We are doing this in the books of purchasing company or selling company. So in selling company, don't write equity share capital. You simply write equity shares of the new company, which is Hari Limited, worth 4,20,000. So ledger closed. Okay, now in fact, even Hari Limited has a balance. You can open Hari Limited ka ledger also. They don't know whether they've done or not. It's fine. Hari Limited is also ledger you open. When you open ledger, what will be the posting in Hari? If you write Hari over here, here you have written Hari to realization account, PC. So first you will write to realization account 5,30,000. What did all you receive from Hari Limited? We receive some new preference shares, some new equity shares. You receive cash from Hari means the entry is cash account debit to Hari. If you have received equity shares means, don't write equity share capital. You write buy equity shares 4,20,000. Then you write buy preference shares. How much did we receive? 1,10,000. This ledger also will get closed off. Okay, sir. This one ledger they have not opened. I say prepare that also. We have done it in our regular class. Just say. Okay, now, sir. I'm quickly revising. Hope that's okay with you. The intention is not to do everything. We don't have time to do everything. I want to cover as much as possible in as little time. Okay, I have taken a little extra time for amalgamation, but it is still fine considering the weightage this topic has. Okay. All right. Next. So problem over. No, sir. Selling company ka books we did. Next in the books of purchasing company. What did purchasing company do? They purchase the business. Whenever you purchase a business, three common entries will always come, sir. What is what? Purchasing company purchase the business, no? So the first entry they'll pass is business purchase account debit to liquidator of selling company. Business purchase account debit to liquidator of selling company. How much they purchase this business for? 5,30,000. To the extent of PC, pass this particular journal entry. First journal entry. Okay, sir. Second, when you buy somebody's business, when purchasing company buys selling company ka business, what and all they will get? Assets of selling company they will get. Liabilities of selling company they will get. It is purchase method. So don't write reserves in surplus. Only assets and liabilities. All the assets will be debited. At what value? Agreed value, which is already there in your PC ka working note. So pick it from PC ka working note. Debit all the assets. Credit all the liabilities, which is also there. Then you have debited business purchase account here. It is a dummy account. It's just a routing entry that will get cancelled. Here you have debited. How do you cancel it? Credit it here to business purchase 5,30,000. Okay, na Saru? So now, sir, it is purchase method. No, so you have to compare net asset with PC and all. Yeah. Here, no need to do any comparison because PC was missing. PC is missing, net assets and PC will be same. So you will not get any goodwill or capital reserve. Sir, here we already have goodwill. That is a goodwill given in the question. This is the goodwill given in the question. Other than the goodwill given in the question, no extra goodwill or capital reserve will come to you. If you have any extra goodwill or capital reserve, this journal entry will not match. It will have a balancing figure. That balancing figure, if it comes on the credit side, capital reserve. If it comes on the debit side, goodwill. That's what I said. So that working note of PC versus net asset comparison need not be done if they ask you journal entry. Because the journal entry number 2 only will give you goodwill or capital reserve as a balancing figure. So don't waste your time is what I had told you in the regular class. Remember? But here anyway, PC is net asset. So extra goodwill will or extra capital reserve will not arise. Okay. Third entry is what, sir? You have taken over a business. Can you keep quiet or you have to settle? Settle. Sir, whenever you take over somebody's business, what happened to Vayu Limited now? It is there or it's shut down? Whenever a company shuts down, you have to make a lot of payments. So there will be a lot of chaos. To route the payment, no, we appoint somebody called liquidator. So that liquidator will give the right payment to the right people in the right order. So that there is no fights, confusion, etc. etc. So now this 5,30,000 we have to pay to the liquidator. What and all we gave to the liquidator? We gave some equity shares. We gave some preference shares. So what is the journal entry for PC settled? Liquidator of selling company account debit to equity share capital. Don't write equity share capital 4,20,000. No. This new equity shares are issued at premium. So we already calculated. To equity share capital, how much? 4 lakh. To security premium, how much? 20,000. To what? That's all you gave or you also gave preference shares? Now don't write preference shares, write preference share capital, because this is issued by purchasing company and we are passing this journal entry in the books of purchasing company. So write to preference share capital 1,10,000. That is your entry. These are three basic entries which will come in every amalgamation problem, whether it is purchase method or merger method. All these three entries will compulsorily come. What are those three entries again? Business purchase account debit to liquidator of the selling company. Here selling company is Vayu. Why? Then when you purchase somebody's business, you will get assets and you will get liabilities. So all the assets will come in with debit balance. So debit all of them. All liabilities will come in with credit balance. So credit all of them. Business purchase you have debited. That's a dummy account, just a routing entry. So you have debited here, and to cancel what we have to do? Credit it. So in the second journal entry, credit it. So journal entry ideally should match. If the second journal entry does not match, the balancing figure is nothing but goodwill or capital receipt. If you're getting balancing figure on the debit side, or on the debit side, it is goodwill. If you're getting balancing figure on the credit side, it is capital reserve. Here we are not getting balancing figure because PC was equal to net assets. That's the reason. If PC is greater than net assets or lesser than net assets, this journal entry will not match. You will get a balancing figure. Done now? That is one. Third is your settlement. Settlement entry is liquidator or selling company account debit to cash if you have settled in cash. If you have settled in preference shares, you'll write not preference shares. You'll write to preference share capital. If you have settled in equity shares, to equity share capital. If there is any premium on preference shares or equity shares, doesn't matter. That premium will be transferred off to securities, premium account. So these are three basic entries along with this amalgamation expense, mutual owings, stock reserve, all that can get added. So we have already discussed that. If it comes, go and do it. That's all. Okay, sir. These are basic things. Then the balance sheet. Sir, balance sheet is very, very straightforward. Simply take what, sir? Harika balance sheet. To that you add up Vayu ka balance sheet date. 2 minutes you have. Is it okay? I can run through. I may take another 20 minutes. If it's okay, I'll run through the balance sheet with you. Or if you've got it, I'll move on. That's fine. I can interfere 20 minutes more with your Sapardo time. Okay. So check, sir. If you want balance sheet now. For the heading, you'll give us balance sheet after absorption. Now check. We'll refer the question ka data. It's easy. Maybe I'll bring this data closer. Okay, check. In the balance sheet, what was the preference first here? Okay, what was the equity share capital of Hari Limited? 11 lakh. Okay. So now, will Vayu ka equity share capital come? No. Vayu ka only assets will come, liabilities will come. Reserves and surplus and share capital will not come. So these we can knock off. Yes, now we'll cut off this. But did we give 11 lakh already they had? Did new company issue any equity shares? Yeah, they issued equity shares worth 4 lakh. They issued preference shares worth 1,10,000. So add these to how much is it? 16,10,000. So that 16,10,000 should be the new equity shares, new share capital in the balance sheet. That's all. So take purchasing company equity share capital. What and all you gave us PC. Add it up. Done now. Any problem? Everybody getting it? Balance sheet is the easiest according to me. Hope you're getting it there. No issues. Okay. Reserves and surplus. Now same. Will reserves and surplus of Vayu Limited, the selling company, come? No. But will Harika come? Yes. Only this much or extra? Extra. To this, if you have any capital reserve, add. Is there any capital reserve in this problem? Zero. But do we have any securities premium? Yeah. Equity shares was issued at a premium of 20,000. So add this. How much it will become? 90,000. Check, have they shown 90,000? Yeah. That's all. So the best way to prepare balance sheet is journal entries. Journal entry will give you whether share capital, assets and liability have increased or whether it is reduced, what has happened. Accordingly, take a call that. Fine, sir. And long-term provisions. For other assets and liability, check, sir, in this problem, all other assets and liability straightforward. Long-term provision, was there any adjustment or it was taken over at book value? So 50 plus 20 you do, which is 17. Creditor, was there any mutual owings? No. Add these two. How much is it? 2,10,000. If there is any mutual owings, you need to deduct. In this problem, there or not there? Not there. So this is 2,10,000. So 70 and 2,10,000 they've taken off. Yeah. Total of liability side matched. Now asset side. Asset side ka PP. Here, sir. What is 1 second. What is PP of Hari Limited? 8 lakh. So Vayu Limited ka PP, can we take over book value or there was agreed value? So come back to the adjustment. Building was taken over at 150. Machinery taken over at 160. So to this 8 lakh, add 150, add 160. So that will be 310. So this will be what? 11,10,000. 11,10,000. So check, have they shown PP at 11,10,000? Where it went? Here 11 lakh 10,000. That's it. So take purchasing company ka PP value and take the agreed value of PP of the selling company. Go on adding. So goodwill they have only given. What is purchasing company ka goodwill already there? Check in intangible assets. They would have prepared a working note. How much is Hari ka goodwill? 50,000. Why? What is Vayu ka goodwill? 25,000 given, but this is book value. We want book value of selling company or agreed value. What is agreed value of Vayu? 50,000. To this 50, add 50,000. Cut off this. It's not taken over at 25. It is taken over at 50. So how much is that? 50 plus 50 is how much? Obviously 1. Like that. Okay. Inventory also same thing. They have given all. You can get this value from PC also, because in PC you will only show what's agreed value. So take Hari Limited ka purchasing company ka asset value. To that you add selling company ka agreed value. Agreed value you will get it from PC ka working. That's all. If there is any mutual owings, one more I'll tell you. If there is mutual owings, you have to reduce it from trade receivables as well as you have to reduce it from trade payables. That is one. If there is any stock reserve, you need to reduce it from inventory. Is not there in this problem, it may come in your examination question. That's all it can get added. That's all is a complexity of amalgamation. 2 or 3 more adjustments like this can come, which we have already discussed as theory. It may get adapted as a question for you in your exam. So will you be able to manage that if it comes? Just in balance sheet, you need to do this. Yes, sir. So this is about purchase method. I want to do one question. We did now what to do in the books of selling company, what to do in the books of purchasing company for purchase method. One problem we will do it for merger method. One problem for PC we will do, another 20-25 minutes we'll wind up. Is that fine? Sorry, I estimated too much. I should have probably given a break at 12:30 only. This took a lot of time than expected. My apologies from my end. I'll get it corrected next batch. Not next batch, tomorrow. Yeah? Tomorrow I will give you right break on the right time. First, now since I've started, I don't want to leave it midway. I'll finish off this. So 2 companies are given, P Limited and V Limited. Okay, balance sheet I know is not important for us. Directly let's dive into adjustment. All bill receivable of V Limited where P Limited ka acceptance. Bill receivable of V. What is bill receivable of V? They have given a breakup here, which is what, sir? 80,000. It is P Limited ka acceptance. That means for V Limited it is bill receivable. For P Limited it is bill payable. What do we call such transaction as? Mutual owings or intercompany transaction. Should we show this intercompany transaction or eliminate? Eliminate. Where? In the new company books. First take over and then cancel. Like that. Yes. P took over V Limited. So P is a purchasing company. V is the selling company. They only told it is amalgamation in the nature of merger. When they say don't test the condition, just start doing merger method application. It was agreed that to discharge consideration, obviously if you're purchasing someone's business, you have to give PC. How is PC given? To allot 3 fully paid up equity shares of 10 each at par for every 2 shares. So if you are taking over, if you take over 2 shares means you'll issue 3 as PC. For every 2 shares acquired, you're giving 3 shares as PC. That's what is the share exchange transaction that they've done. Correct, sir? Alright. It was also agreed that 12% debentures in V Limited. Come back to the balance sheet. Are you able to see any long-term borrowing? Yeah, they prepared note number 3. Come to note number 3. Here, 12% debentures. So selling company has 12% debentures. How much? 1,000. All these numbers are in lakhs. What are they saying for that? Would be converted into 13% debentures in P Limited. It's quite obvious, no, sir. What is happening to selling company? There or shut down? Shut down. So what will the debenture holders of selling company say? Either give me my money back or give me new company ka debentures. That is what is happening over here. 12% debentures in V Limited, that is selling company, is converted into 13% debentures of P Limited of same denomination. Just a barter system. Old one will get cancelled and new one will have to issue. Okay. Trade payable, trade receivable ka breakup they have given. Expense of amalgamation is 1 lakh. You are required to pass journal entries in the books of P Limited, the purchasing company, and P Limited ka balance sheet immediately after merger. Balance sheet I'll leave. I think you're comfortable with that. I'll quickly run through the journal entries. Before we do the journal entries, we need a PC. Correct? PC missing or given? Sir, clearly they told, no? 3 equity shares we will allot for every 2 shares. For 2 shares, we will allot 3 shares as PC. So ratio is clearly given. If you have 2 old shares, we will issue 3 new equity shares. That's what they told. So check the balance sheet of V Limited, sir. What is the share capital of V Limited selling company? 6,000. They have not given breakup. I am assuming that share capital, each share ka face value is 10. You can assume whatever, it's fine. Final answer will not change. Total share capital is 6,000. Each share ka face value assumed as 10 means the number of shares will be how much? 600. Correct? Now? If you have 2, you will get 3 SPC. If you have 600, how 600? I've assumed the face value to be this given number or assume? I've assumed the face value of each equity shares to be 10. You can assume even 100 also. Final answer will not change. Total share capital 6,000. Each share ka face value 10. So number of shares will become 600. So if you have 2, you will get 3. If you have 600, how much? If you prorate, it will be what, sir? 900. What is this 900? In fact, what is this 600? Value or number? Number. So this 900 is the number of new equity shares. We need the value. Each equity shares have assumed it as how much? 10. So that means the value of new equity shares will be given as 9,000. This is your PC. Okay, merger method. Okay. So merger method ka funda is, in merger method, no sir, visualize. We first find out PC. Steps. Remind your steps. What did we write? First we have to calculate PC. Done. Then find out paid up capital. Did I use the word paid up equity share capital or only paid up capital? Paid up capital. Because under merger method, it's a reorganization. Visualize. What is the only thing not taken over? Capital. Paid up equity share capital we can't take. Purchasing company can't take over. And preference share capital also cannot be taken over. Rest all the thing, assets, liability, and even the reserve will be taken over only and only at book value. Okay, so you need to find out paid up share capital. Paid up share capital here means paid up equity share capital and preference share capital. Come back to Harika balance sheet. What is paid up share capital? Only one, which is 6,000. They have not given the breakup, so most probably it is equity share capital. So PC is 9,000. Paid up share capital given in the question is 6,000. So paid up share capital is like your worth. Because that is the only thing not taken over. No, 6,000 is not taken over. That means you should have issued new preference shares or new PC worth 6,000 only. No, 6,000 was not taken over. So new instrument should have been given only for 6,000. But new company gave it for 9,000. Or if you want to even decode further, think of paid up capital as net worth under merger method. Think of paid up capital as net worth. It is not, but just for doing the things correctly, you can assume like this. So worth is how much? 6,000. But how much PC was given? 9,000. So purchasing company paid more or they paid less? They paid more. Instead of paying 6,000, they paid 9,000. So purchasing company paid more. If purchasing company made more means they suffered a loss. Purchasing company suffered a loss. That loss will be accounted as goodwill. If you show it as goodwill, it will become self-generated goodwill, which you cannot show. Hence, this loss is adjusted in reserves. Usually, which reserve? General reserve. So the amount to be adjusted in reserve is 3,000 rupees. That's a work. Keep this in mind and then start your journal entries. So 3 journal entries. Tell me some basic journal entries. What is that for basic journal entries? First, business purchase account debit to liquidator or selling company. You will pass this journal entry to the extent of PC. When you buy business, what will the purchasing company get? Selling company ka all assets, all liabilities, not just that, all the reserves and surplus also, because it is what method? Merger method. So all the assets will be debited, because all assets will come in with debit balance. All liabilities will be credited at the book value. That's all, or even reserves and surplus. Reserves and surplus. What is the reserves and surplus of selling company? Foreign project reserve 310, general reserve 3,200, P&L account 8250. One by one you need to show, but general reserve you will not show it at 3,200. Why? Sir, we have to adjust something in general reserve. No, how much you have to adjust in general reserve? 3,000. So though you are taking over 3,200, you have to adjust. Since we made a loss of 3,000, this will be adjusted with general reserve. So how much balance will be there? 200 rupees. Okay, na sir? Any problem? Or if you feel, no sir, I'm not comfortable with this adjustment. Sir, if purchasing company suffers a loss we have to adjust it in reserves. Which reserve I told? General reserve. So when you're passing the journal entry, no, don't write general reserve. Don't write general reserve. Rest all assets, all liability, all reserve, you put it at book value. Your journal entry will not match. There will be an exact difference of 200. That difference itself is general reserve. So that means you don't have to break your head down. Or if you want logic, general reserve balance was 3,200. We adjusted 3,000. So it has to be 200. Either calculate like this or get this as a balancing figure. Choice is yours. But do it correctly. Whichever way you do it. Okay. In exams, no, everything they won't ask whether you know it logically or not. That's a drawback of our exam. Whether you have done correctly or not is a funda. Whether you have understood and done it properly and all is a secondary. Okay, whichever way you have, because on last moment, no, you should not worry too much about logics also sometimes. Ideally, you should prepare logically from day one. But now you are probably 1 week before exam, 2 weeks before exam. Now you say, I will study everything logically. Logic will not help you. Okay, logic will become tragic for you. Yeah, like that. Yeah, so let's not get into that. Good to know it, but there is a right time for it. Okay, so if you are not getting an examination time, you should not waste too much time because time is very, very limited. So certain shortcuts like this also will help you to ace the exam. That's what we say. CA is more about smart work than hard work. So sometimes even if you don't know also, you can pass. Like this, see, if you logically know balancing figure, general reserve, good enough. You don't have to know how you got it also. Answer match, like that. That was also, those are also sometimes pays off. Okay, 2 entries are done. Third one is settlement to liquidator. What is the journal entry? Liquidator account debit to equity share capital. This is your 3 common entries. Other than this, in this problem, you may get some mutual owings. Here we have mutual owings. Yeah. Bill receivable for one company, bills payable for another company. So you did not show only. Sir, I showed already. Here, I've accounted debtors and all. No? I've taken total debtors. How much is total debtors given in the balance sheet there? Harika. Now, where is it? Pia. Hariyala. Where? Here. Total trade receivable is how much? 1,100. This includes your mutual owings. This breakup only they have given it here. How you got 1,100 is the breakup of this. Okay, 1080 is debtor. This is the total receivable, sir. In this 1080 is debtors and 80 is bill receivable. Put together, debtors and bill receivable put together, we show it as trade receivables in balance sheet. So I have taken over full 1,100. Check here. So that means I've already taken over debtors. First take over and then cancel the mutual owings. Same thing for creditor also. What is the total creditor? Bills payable was 0. Creditor was 463. Total is how much? 463. How much did we take over? Where is that? Okay, breakup. Not written. Maybe I'm a mistake. I think Josh, I forgot. I think. Okay. So this should be here, sir. I think they don't have. Or maybe they don't have. Oh, they do have. I missed out. I think, okay, no problem. I think this is just typing. Josh, I only wrote it in the morning. So maybe Josh mate got missed out. It should come. Okay, fine. It somehow got missed out over here. It should come here as what's a trade payable. How much is the trade payable total of V Limited? 463. That should also come. Okay, first take over and then cancel. I've just done hurry, so it is missed out. Don't say it is mistake. Okay, quickly I've done. So that's the reason. Okay, so first take over and then cancel. So what is the cancellation journal entry for mutual owings? Liability also you need to cancel. Asset also you need to cancel. Liability has credit balance to cancel, we will debit. Asset have debit balance to cancel, we will credit. So the entry will be bills payable account debit to bill receivable account. That is one. Okay. Then they told 12% debentures of V Limited will be converted into 13%. So we took over 12% debentures here in journal entry number 2. Are we issuing 12% debentures to these debenture holders or new debentures? So this barter system, you have credited here, no? So debit 12% debentures of V Limited and credit 13% debentures. Don't write 13% debentures of P Limited. In P Limited books, will we use P Limited name or not required? So if you write 13% debentures, that automatically means that this debentures belongs to P Limited only. Same value, no change in value. Okay, sir. All right. The last one is amalgamation expense. It's a merger method, yes. And we are doing an adjustment in reserve, means it's a case of a loss. For amalgamation expense, what is the journal entry, sir? For merger method. Amalgamation expense, not reserve, statutory reserve. You are telling me the entry for statutory reserve. I am asking the journal entry for amalgamation expense borne by P Limited. For merger method, that depends on the scenario. So basically the entry is general reserve account debit to bank account, or usually I told study material passes this entry through P&L. So the entry for amalgamation expense will be P&L account debit to bank account. In my opinion, even if you write general reserve to bank, it should be okay. Okay. So that's your entry. Based on this entry, you need to prepare new balance sheet. Balance sheet can you manage that to merger method? So that means will you have even one asset revalued? No. Line by line balance sheet you need to add. Take selling company ka balance sheet value. Take purchasing company ka balance sheet value. Go on adding one by one. Don't add share capital. That's one. Okay. Because you can't take over selling company ka share capital. You will issue new shares as PC. That's the only drama. Can you manage that? Okay. One problem around PC I would like to manage. That's okay, I believe. There's one different kind of PC problem which quickly we'll run through. Sun Limited and Neptune Limited have been carrying on the business independently. They agreed to amalgamate and form a new company, Jupiter Limited. Share capital of Jupiter is rupees 4 lakh divided into 80,000 shares of 5 each. Keep this in mind. New share capital ka face value is not 10. Normally we assume face value of face value of equity shares to be 10. Don't assume 10 here because they will not give the adjustment again because they gave in the first line only. New company ka new equity shares ka face value is only 5. Keep that in mind. All right. Now they have given Chintu assets and liabilities of Sun and Neptune, but they also told revalued amount. So the moment they say revalued amount, merger method or purchase method? Obviously, it is a case of purchase method. Will we take over book value or only revalued amount? Because net asset means assets taken over at agreed value. So this is value we have to take over. Yes, sir. Debtors and creditors includes 45,000 owed by Sun to Neptune. So this only we call it as intercompany transaction or mutual owings. Where will we eliminate this? Sun ka books, Neptune ka books or new company ka books? Only in the books of new company, both debtor and creditor will be eliminated. That's one. Okay. All right. PC. PC will be satisfied by issuing shares and debenture. So debenture is not PC, sir. If you give something to the debenture holders of selling company, if purchasing company gives something to the debenture holders of selling company, are debenture holders of selling company owners? Sir, PC means what you give it to the owners. Is debenture holders of selling company owners? No. To them, if you give anything, it is not PC. To the equity shareholders and preference shareholders, whatever you can give cash, you can give debentures, you can give equity shares, you can give preference shares, doesn't matter. Whatever you give, everything will be considered as PC itself. So here clearly they only told PC is satisfied both by issuing shares and debentures. The shares and debentures are given to equity shareholders and preference shareholders. No information about preference shareholders, so I'm thinking it's given only to equity shareholders. Okay, 60,000 equity shares to Neptune and Star in proportion of profitability of respective business. So totally how many equity shares will be given by new company? 60,000. Okay, there is one selling company here or two? Two selling companies, because who is the new company? Jupiter. Sen is a selling company, or in fact both are what, sir? Selling company here. That means owners of selling company will get PC. How much PC is given in the form of equity shares? 60,000. The 60,000 you have to distribute to Sun also, to Neptune also. Based on what they told, in proportion or in the ratio of profitability, but they also told based on average net profit for last 3 years. So you have to find out average net profit. In that average net profit ratio, 60,000 will be distributed. First, let's find out average profit. Take your calculator, find out the average of this for me. In fact, they've only done here. If you want, you can also confirm. These three ka average. How do you find out average? If they give you 3 years profit, add all the 3 years ka profit divided by 3. If there is any loss in between, means what do you do? Profit means you'll add. If any years in between has a loss, you need to subtract. So average, if you do, for Sun it is 275 and for Neptune 325. Correct? 275 and 325 is average net profit. So in this average net profit ratio, you have to distribute 60,000 shares. Me telling or problem telling? Problem telling. So what is the ratio of this? 275 is to 325. So 60,000 basically you have to apportion in 275 is to 325 ratio. How much will Sun get? If you calculate this. 60,000 in doing this ratio, 300, 300, 600. So 27,500? Yes, sir. Yeah. So Sun will get 27,500 shares because 60,000 is not the value. It is the number of shares. Neptune will get same. 60,000 into 32,500 or 325 divided by 600. That is, if you do that ratio, you will get 32,500 shares. And each share, we want PC means number of shares or value of shares. Value of shares don't multiply 10. Value is only 5. They gave in the first line only. Okay, mistakes there. Okay, common small mistakes can kind of bring you down big time. So keep a track of that. So 25,000 shares, each ka value 5. So how much is the value? 137,500. 32,500 into 5 will give you 162,500. This is equity shares given as PC. Is PC given only in the form of equity shares or also debentures? Also debentures. Check what are they saying for debentures. 15% debentures in Jupiter Limited, new company, at par to provide income equivalent to 8% return on capital employed. Stop there, sir. Do we know this capital employed? Yeah, capital employed is nothing but shareholders' funds, which is nothing but net assets. Okay, so we may not understand whole thing, but at least little bit we understood, which is what, sir? 8% return on capital employed. That means first we need to calculate net assets, multiply 8% on that. That much we have got it. So first let's calculate that. Net assets means book value or agreed value? Agreed value. Sir, for PP and current assets, we can't take over. This is the book value. This is the revalued amount. So what should we take? Revalued amount. So take your calculator. 7,10,000 plus only two assets are there, one liability is there. That's all. 7,10,000 is a revalued amount of PP. Revalued amount of current assets is 299,500 and current liability value is 5,97,000. Deduct current liability value. How much are you getting?
4,12,000.
That's what they've done here. Assets they've added, liability they've deducted, but agreed value you're going to get 4,12,500. This is for Sun. Same thing if you do it for Neptune. You're going to get 3,67,500. Agreed? There's net assets. You want net assets or what did they say? 8% return on capital employed. You got your capital employed, which is nothing but net assets. Calculate 8% of this. 33,000 for 4,12,500 into 8% if you do, you're going to get 33,000. 367,500 into 8% if you do, you're going to get 29,400. Correct? That's what we said. Now let's come back to the adjustment and read it again. 15% debentures in Jupiter Limited are issued at par to provide an income equivalent to 8% return on capital employed. You have to give debentures in such a way that the income to the debenture holders, should be equal to 8% on capital employed. How much is 8% on capital employed? 33 and 29,400. Let's concentrate on Sun for the time being. What is 8% of net assets or capital employed? 33,000. You have to give debentures in such a way that the return that the debenture holders will get should be equal to 33,000. Is my statement right?
Yes.
I'll repeat it once again. You have to give debentures to that extent where the return to the debenture holders should be equal to 33,000. Okay. Now think, sir, what is the return for the debenture holders? If you buy some other company ka debentures, if you invest in some other company ka debentures, what is the return for you? Interest. Yes or no? Excuse me. So what indirectly they're telling is, issue that many debentures where interest on new debentures will be equal to 33,000. Because the return for the debenture holder is nothing but interest. So you have to issue that to value of debentures where the interest amounts to 33,000. So how do you calculate interest on debentures? Can you give me in formula? Debenture interest is nothing but debenture ka value multiplied by the interest rate. Correct? We'll take debenture ka value multiplied by rate. So if I give you debenture ka interest, if I give you interest ka rate, can you find out debenture ka value for me?
Yes.
How do you find out debenture ka value? Debenture interest divided by interest rate. That is what is given over here. Do you know the interest amount? 33,000. Do you know interest rate? Yes. What percent debentures are these? 15%. That means these debentures carry an interest rate of 15%. Interest amount is 33,000. Interest rate is 15%. So basically to get debenture value, we simply have to do debenture interest divided by debenture interest ka rate. So 33,000 divided by 15%. 15% if you have to express in full number, it will be 0.15. Do that. How much you going to get? 2,20,000. Similarly, same thing here also. Interest amount is 29,400. Interest rate is 15%. So what will be the debenture ka value? 1,96,000. That's your PC. If you add these two, you're going to get PC. Okay, Nasaru? Sir, directly they asked you to prepare balance sheet. Directly they ask you to prepare balance sheet. This is which method? Asset got revalued. So which method? Purchase method. In purchase method, you have to compare PC with net assets and you'll get goodwill or capital reserve. But is that working out compulsory? No. When you pass journal entry number 2, you'll get goodwill or capital reserve as a balancing figure. So journal entry number 2 is a substitute for that working. But in this problem, did they ask you journal entry or no journal entry? So I will prepare journal entry. God help you, you can. But wastage of time. Yes. They've not asked journal entry. So why do you waste time? That means in this problem, we have to prepare goodwill or capital reserve as a working. So compare PC. PC is given in two formats, equity shares and debentures. For Sun also, for Neptune also. Compare it with net assets. Net assets also we have already calculated with this working note. Capital employed is which is nothing but net assets. All things are already there. Just compare, you will get goodwill or capital reserve. Here net asset was 4,12,500, but PC was 357. So net asset means net worth of a business. Worth of a business is 4,12,000, but PC paid was only 357. So you paid more than the worth or less than the worth? Less. So purchasing company made a loss or profit? Profit. So capital reserve. So in both the case, you'll get capital reserve. Use this capital reserve and prepare balance sheet. That's all. Balance sheet also. Now don't say book value. Is this merger method or purchase method? Purchase method. So take what, sir? What value you need to take? Agreed value. Okay, fine. One is equity share capital. You're preparing amalgamation or balance sheet in whose books? Jupiter ka books. What will you write as equity share capital? What will you write as equity share capital? Sir, Jupiter Limited issued how many shares? 60,000 shares. Don't write into 10. Each ka face value is 5. So you'll write 60,000 into 5. 3 lakh is your equity share capital. Then you'll show non-current liability. Then you'll check the balance sheet. You'll not find any debenture here and you will miss. But debenture is still there. It may not be there here. But was PC given as debenture? Yes. So that means PC is given in the form of debentures. Here it is there. No, this 220 and 196. This debenture is issued by new company. That will be there. So that is what I've written working note number 2 here. Okay. Here. Yeah. This one. 220 and 196. If you add this, you're going to get 4 lakh 16,000. Done, sir. In fact, this is your reserves and surplus. Reserves and surplus, we have capital reserve here. No? What is the capital reserve? 64,000. So that I've written it over here. Rest all the assets you copy from question ka balance sheet, but don't take book value because it is not merger method, it is purchase method. For merger method, we only take book value of assets, liability and reserves and surplus. But for purchase method, we take over all the agreed value. If agreed value is not given, we assume that agreed value and book value are same. In that case, you can take book value. In all other case, for purchase method, compulsorily you have to take over agreed value only, purchase method. Okay. So these are some of the types of problems which I saw. Okay. So with this, we have completed amalgamation ka full revision. Thank you. So where will I get this PDF? I told no Darshan Garu at the beginning. You can purchase it from our website. learn.arivupro.com. Watch the video at the beginning. I've showed you where to purchase it from. I've showed you that website. Okay. Thank you.